But we will see what that actually shakes out like. And then Vivendi is the other one that's catching my eye this morning. Is potentially selling its 24%, about 24% stake in Telecom Italia for the very first number that we're getting, which is about 2 billion euros. So, Guy, we are getting numbers around Vivendi. We got some early signs yesterday. We'll see how that shakes out in just a few minutes.
Okay, we certainly will. It is time for the opening trade. Let's see what we get. London is going to be back. You've got oil stocks in focus. You've got the mining stocks in focus. They're going to be two areas that we're going to be watching out for carefully this morning. So commodities, an area of the market that we're going to watch out for. London is out of the gate Tuesday. Feels like a Monday, but we've got some volume coming back into the market, which is going to be significant, despite the fact this is the kind of the Christmas week for the summer. That's kind of what it feels like in some ways, in terms of how we should think about what we are seeing here. But London is up by 0.4% as anticipated. Elsewhere, the stock 600 is super quiet, barely budging at the moment. We're up by less than 0.1%. The CAC 40 is up by 0.1%. The IBEX is up by less than 0.1%. Christmas in summer, Ollie. That's maybe how we're thinking about it. But beneath the surface, I'm sure things are going on.
Yeah, Guy, I've never really heard that before. Christmas of summer is an interesting sort of formulation for the markets this morning. And if Christmas came early, then it was for basic resources, which is up about 0.6% this morning. This is the best performer in Europe at the moment. Travel and leisure down by about 0.5%. That is the sort of big loser there. Technology selling off again about a quarter, about 1%. We saw it fall about 1% yesterday. And remember, yesterday in the session, we did see real estate outperform. We're not seeing that again this morning, which is basically dead flat. So the winners this morning, basic resources, losers, technology, and travel and leisure.
Got a little bit of oil love in there as well when you look at the FTSE 100. And some of this is going to be just a magnifying the move that we're seeing in the macro as well. An 81 handle on Brent crude. And remember, this is coming off of, I believe, a 3% rally in yesterday's session off oil as well. We haven't really talked about this. This has been like a Libya output story where you are seeing the Eastern Libya government shut down some of their oil pipeline flow. There has been mixed reviews about whether or not this is something that sustains. But the way it's showing up in the FTSE 100, which, by the way, was closed yesterday, higher by about 1.4%. The likes of Shell, BP is your outperformer. But then you've got a little bit of your other commodities as well, to your basic resource point. Anglo-American is one of them. It looks like we're still getting, I'm trying to find BHP here, but it hasn't shown up yet. But it looks like commodities very much in focus, Guy, this morning.
Unsurprisingly, decent numbers coming out of that company. It paints a positive picture. I think these companies are making money even if China has slowed down, which I think is really significant and quite important for this cycle. Yeah. Though it's interesting, Mike Henry's talking a lot about copper. He sees that as the future. Remember, we had the failed takeover. He still sees that copper story as being super important for him. So despite the fact that others are sounding cautious when it comes to consolidation, Rio Tinto, we do still see some companies within this space talking potentially about some big deals, still being needed and relevant.
Yeah, with a real drag in the manufacturing sector, which we've seen, across Europe. Obviously, we've seen it in Germany, but even the manufacturing PMI over the United States. So maybe some of those that demand just is not there at the time for the time being.
And I should mention that BHP is trading higher by about 1.5%. On your screen right now, you're seeing Rio Tinto higher by 1.4%. I think we're still waiting for the BHP numbers to shake out. I'm not seeing a ton of volume showing up. But when we get that live pricing, we will bring it to you. We talked a lot about the upside. Let's talk about the downside as well, because, of course, NVIDIA seems to be the big macro event that we are seeing on Wednesday. In the lead up to that, Guy, we're seeing a continuation of that pain in the tech trade. ASML, SAP, some of your biggest weights and some of your underperformers on an individual basis this morning.
Well, yes, there is sort of sell-off in the NASDAQ.
Yeah, so it's just a catch-up.
It's just, there's a kind of...
Get excited, Guy.
The sell-off in the NASDAQ, I think, was significant. There is a rotation. Clearly, the market is reacting. I think probably less to the build-up to NVIDIA and more to the build-up to the Fed cuts. So you're sort of seeing that turn start. Is it a step too far, though, to believe that you want to be buying small cap, mid cap stocks in an economy that theoretically, according to the Fed, is slowing. Even if you get a soft landing, is that the space you want to be in? I think is a key question. And I think you are seeing a kind of knee-jerk reaction maybe to Jackson Hole.
Yeah.
Whether that has got legs. We've already seen one head fake already into that move.
Yeah.
Is this another one?
So still very much macro driving the story. We actually asked Pooja Kumar over at TD Securities that very question on what her outlook looks like. Take a listen to what she had to say.
Holding OETs versus Bundeswehr is going to be something that you will like to see play in September and October. And also, it's not a generally done trade, but actually holding UK versus France, which just makes sense, given the fact that you are seeing much more fiscal deviation in France.
Pooja Kumar there from TD Securities, speaking earlier on the program about the need to keep an eye on, well, really all the markets. It looks like the Fed seems to be in control right now when it keeps in terms of driving the macro trade and whether or not those rate cuts actually spur some investment in American assets, pull some out of Europe. We'll see how that all shakes out. Paris Anand, CIO over at Artemis, joins us around the table this morning. Good morning.
Good morning.
Welcome to the set. Thank you so much for joining us. Give us your take here. Is it really all about the Fed? Is that the only driver here, that a 25 basis point rate cut in September or a continuous easing cycle that we see into the back half of the year? Is that the tailwind for stocks right now?
Well, it's a great question. I think that actually my assertion would be that the market is overly focused on the sort of direction of central bank policy. And I would say that that's been an obsession with the market over recent years. And actually, when I think about what is going to shape the real economy, what's going to shape markets overall, actually whether the Fed chooses to cut by 25 basis points or 50 basis points, or the direction of cuts, is going to have much less impact on the broad outlook for corporate earnings and the broad outlook for markets in general. I think it will have these short-term knee-jerk reactions just because of the sort of reaction function in markets. But I would say one of the most significant themes for the coming year is that actually people should be focusing less on the actions of central banks.
So in terms then of kind of the pain that we've seen arguably in the States and kind of this rebound that we're seeing, I'm curious how that translates over to the European story. We were reading some of your notes earlier. You've got your own little acronym. We like to talk about granolas over at Goldman.
This is a breakfast show.
You've got your sensational six.
Yeah.
I believe you're calling them Cheerios.
Yeah, absolutely. So what we were doing in terms of the granolas versus Cheerios was really trying to sort of put into the foreground the idea of the extent to which that kind of market concentration that we've seen in lots of the equity markets globally has also been sort of mirrored in Europe. There are certain companies that seem to sort of meet certain standards in terms of their, people's perception of the quality of the companies, and hence that willingness or that belief that they will grow and they will offer good returns for shareholders, whatever the kind of the macro environment. Our sort of assertion is actually when you look deeper within the market, you can see such great value on offer. And one of our core beliefs over the coming years is that valuation, the starting price you pay for a security, will have much bigger explanatory power in terms of the future returns in the cycle to come versus what we've seen over basically the last decade.
Why is that? What is the underlying change, the underlying assumption that is going to shift to make that happen? Because cheap money has made exactly the opposite happen. Are you suggesting that era is now over?
That's exactly right. And I would say that one way to almost look at it is that when you're in that zero interest rate policy world, the natural gravitational pull for multiples is up.
Yep.
And the propensity of investors and the way the value accrues is all in those kind of much longer duration assets, whether we look at fixed income or equities. But we are now in a fundamentally different environment. We're going to have higher interest rates across most markets, especially in the West, for an extended period of time. And what that means then is that gravitational pull of multiples is actually down, not up. And therefore, actually thinking about what your starting price, what your starting valuation is, becomes much more important to the shape of future returns.
But valuations are elevated now because of that cheap money. Do we need to see a reset of those valuations in order to make what you are talking about come to pass?
Well, I guess this comes back to the granolas versus sort of Cheerios point.
So the reset's already happened, or it hasn't happened in those stocks. So they're already cheap, is what you're suggesting.
No, what I'm saying is that because of the extent to which you talk about valuations being expensive.
Yeah.
Now, the value in public markets, those more lofty valuations were accorded to actually a relatively small percentage percentage of the overall market. I'm much more concerned actually about the valuation of those kind of that bubble, if you like, is much more in private markets than in public markets. Most public market investors didn't really get the chance to participate as strongly. So therefore, when you look more deeply within the market, there's actually a lot of value on offer, and there has been for a number of years.
Does the index, but thinking about it from an index point of view, does the index need to reset for that to happen? I.e., if we see a shift away from the high-value tech names, the Magnificent Seven, the granolas maybe, does the index fall in that kind of environment?
In part, it does.
Right.
In part, but also but the most important thing is the internal rotation within the market, and therefore I think what you're more likely to get is almost kind of directionless or kind of sideways tracking markets within which there'll be a much more profound rotation.
But somewhere where we will continue to pay attention to the central banks is potentially in the FX market. And I'm looking at cable right now up at 132, which kind of snuck up on me. That's really moved precipitously in the month of August. How far can you see that actually going? How strong can cable get when you see the sort of differences that we're seeing between the Fed and the BOE?
Yeah, so I mean, look, if you think about the sort of the devaluation of sterling relative to the dollar, that's a story that's going back almost sort of 10 years now.
It's very personal to me because I moved to London in 2014 and at 166 and out at about 115. So yes.
Yeah, and when I used to live
I want to see where we can get back to.
Yeah, when I used to live in the US, the dollar was sort of $2 to the pound, right? So it's kind of it shows you how profoundly these kind of swings in currency valuation can occur. No, I think our medium-term view is that actually there will be kind of ongoing downward pressure in the dollar. When you look at the sort of long-term fair value metrics, you look at purchasing power parity, you look at all of those sort of factors, and what I anticipate happening in terms of the need for the US government to continue to issue bonds in order to kind of service its sort of fiscal needs. I do think that's going to put downward pressure on the US dollar against sterling, but also against other currencies as well globally.
Yeah, and it's sort of music to my ears to hear you say we need to stop paying attention to central banks quite so much because it seems to be the only thing that is really driving things within the sort of the equity markets. My question to you is how much do you think about geopolitics, particularly the question of trade, is going to be a protagonist in the question of markets?
So I think elevated geopolitical sort of tensions are something that actually, again, we've lived with for quite a period of time. And I think it plays its own role in why I think what we're going to be living with for the foreseeable future is just more kind of elevated inflation, especially in Western economies, because, it is a source of, it can be a source of supply chain disruption. It can pull forward certain types of spend, which are not spend of discretion, they're spend of, compulsion. All of those things end up putting pressure on, prices in the medium term. So, one of the key things that we talk about is this idea that, inflation isn't a single phenomenon that comes in a kind of, a wave and then it sort of disappears, which is where really the focus of the market has been. What is going to happen to this particular individual cycle of inflation? Actually, when you look back over history, inflation is more persistent and it occurs in waves. So one of the things that I think market participants shouldn't get too comfortable with is the idea that there's this one period of inflation spike, it'll spike and then disappear. I don't think that will be the case.
Well, one of the arguments for that resurgence of inflation, or even persistent inflation, as you put it, has been the fiscal spend that we're talking about. There's also an argument over in the States, and I'm going to throw Europe in here as well, that you just follow where the government is willing to spend the most. So in Europe, it might be the defense sector, and you've seen that sector outperform. In the States, it might be the chip sector, simply as a function of the CHIPS Act. What does that trade look like in the next 6 months, and arguably the next 12 months as we get a new administration?
So I think that, again, when you think about, the direction of travel for most of these Western economies, and you think about the direction of travel of government economic strategy, and I think this is going to be the same whatever the outcome of the election in November. I think there will continue to be that elevated level of government spending on fixed asset infrastructure, also mirrored by, I think, the corporate sector is going to be spending more on fixed assets. Sure. And I don't really think that that's a decision of, election or it's something that they're doing voluntarily. I think it's something that they have to do. Yeah. I've just spent the summer traveling in the US and Canada. And having recently sort of lived in Singapore and travelled around, Asia as a region, you sort of compare the infrastructure between the economies that we describe as sort of developing economies and, the mature economies in the West, and the infrastructure is creaking.
But 4 years ago, and I fully hear your infrastructure point, your government point in that, but 4 years ago when we went through this election cycle in the States, there was a very clear trade, a Trump trade, a Biden trade, and you could see the markets trading tech on it, trading bonds on it, et cetera. That trade doesn't seem to emerge yet, and we are two couple months counting going into the election. Why is that? Why is there that absence? Is that a dislocation in the market setting us up for some sort of surprise come November 5th?
No, I mean, again, I think that when you look at sort of some of the policies that have been put in place over recent years, one of the things to remember is that when you talk about sort of big infrastructure bills and things like that, they take several years to play out, right? These are not things that sort of they might have an immediate sort of reflection in the market in the very short term, but when you actually look at their impact on the real economy, you're talking about something that is going to shape the real economy for many years in the future. So my argument would be that, don't look for that single trade. Just think about what are going to be the fundamental drivers of the real economy in the US, in Europe, and elsewhere in the world over the medium term.
Paris, great to see you. Thanks for stopping by to see us. We greatly appreciate it. Thank you very much indeed. Paris Anand, CIO at Artemis, joining us around the table. You can pick your granolas. That sounds like a tasty breakfast cereal. Cheerios, I'm sure, are absolutely delicious as well. But
I'm so hungry now.
I like to focus on the core six. Like, it doesn't sound that tasty, but believe you me, it is. Here you go. Novo Nordisk, LVMH, Ferrari, ASML, Schneider, Nestle. Only one of those is down today. Reacting to the tech story yesterday, the Nasdaq's selling off, but you can see it's not that big and greater reaction. Luxury looks like it's bouncing back a little bit today. You're certainly seeing that, and some of the healthcare stocks bouncing back as well. But it's Nestle that leads the charge, up by 0.8%. So that's your core breakfast. That's the core of your kind of breakfast offering, our breakfast offering, first thing this morning. But let's add to it. Let's add a few bells and whistles. Joe Easton's here with the other stocks we need to be watching.
So as expected, Guy, a lot of the action today is in the UK commodity stocks. We're seeing the likes of BP, Shell, Anglo and BHP gaining both a gain in the price of crude oil yesterday, and the iron ore price moving up today on potential rebounds in Chinese demand. Boosting these stocks this morning, as we mentioned earlier, BP has been a bit of an underperformer of late, so that is getting a gain. And BHP, of course, reporting earnings today, potentially better than expected on their copper outlook for that company. Then we'll also take a look at Vivendi and Telecom Italia. This one breaking in the Italian press earlier today. Vivendi potentially going to sell down their stake in Telecom Italia. Potentially some big news out of that market. So we are seeing a gain of around 1% in Telecom Italia today. Another one moving in the UK, though. This one caught my eye. Ocado getting a deal in Australia with Coles, the retailer, for a new automated warehouse. Something Ocado really needs. They've been suffering on a decline in some of those orders for those warehouses. That stock getting a boost. Actually one of the better performing UK stocks today. But the best performing UK stock is Bunzl. Now this one jumping. It's airport catering and also outsourcing general catering as well. Really strong sales out of this company this morning. We're seeing a 12% move higher in that stock, the best performer on the Stock 600 and also in the UK as well. Santander, meanwhile, Kriti mentioned this one earlier, potentially another 1.5 billion buyback coming from the bank over in northern Spain. 1.3% gain for that stock. Pretty decent given the relatively calm markets today. Then we got Zurich Airport in the earnings space. This one actually dropping, seeing some weakness in some of their passenger numbers, according to the company. A 5% decline in that one. Pretty disappointing out of them this morning. But actually, the best performer and the worst performer on the Stock 600 today actually come in the rating space. We've got Continental raised to buy over at UBS. UBS reckons the spin-off of the company's auto parts business, making them focus instead on tyres, could see them return 6 billion in share buybacks over the next couple of years. And finally, AB Foods goes down to sell this one at Deutsche Bank. They think the margin recovery of Primark is coming to an end. They recommend getting out of that one, and we're down 2.7% in London today.
All right, Joe Easton from our equities team walking us through, some of our stocks that we're keeping an eye on. Coming up, we continue that conversation with BHP, up higher as the world's biggest miners' full-year profit edges higher. Basically, they talked about profit, they cut their dividend, they're talking about growth. There's a lot going on, especially when it comes to China's uneven recovery. We're going to dive into the details. after the break. But as we head there, take a listen to what Marcus Garvey, the head of commodity strategy over at Macquarie, had to say about metals demand in China.
The weakness in the Chinese property market is very clear when we look at the ferrous complex, because if you look at long steel production, which is the form of steel that goes into construction activity, it's very soft. It has been for the past 2 years. We've not seen any improvement this year. If anything, we've seen a modest further deterioration.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Property sector itself, which makes up about 20% of steel demand, that is weak. It's been weak for some time. We've seen lower or fairly low levels of both sales and new starts. But the Chinese government is enacting policies that are intended to address that, and that includes relaxing some of the constraints on property purchases. There's a government program underway to mop up some of the excess inventory, and we expect those to start to have effect through 2025.
CEO of BHP, the world's biggest miner, Mike Henry there, speaking about what he sees in the Chinese market, talking about maybe steel demand plateauing at this point, though others firmly believe that there's still further weakness still to come out of that space. But as iron ore is weakening up, he really likes copper, and that seems to be the narrative that he's pushing right now. What does that do in terms of his M&A strategy going forward? In terms of the share price reaction, we need to discuss that as well. We are seeing the mining sector outperforming this morning. It's a big outperformance. Ollie Crook was just joking in the break that this is a sector that is up by 1.4% this morning. That feels in August markets like quite a decent-sized move. I am genuinely getting excited about this. So let's talk about what is happening here. I jest, of course I'm not getting excited about this. Martin Ritchie joins us now to discuss this, Bloomberg Commodities reporter. Let's start off and talk a little bit about China, first of all, Martin. what is this company is still profitable, which I think is really interesting given the weakness we are seeing in China. But what is he telling us about what he sees happening in the Chinese economy and the demand we are seeing for steel products? Because it's not just the housing market that consumes steel in China.
Yeah, that's right. I think there was an interesting contrast, really, between all the sort of very negative headlines, gloomy stuff we've heard about commodities markets in the past few months, versus these results, which are in line with expectations, profits still rising. I mean, that speaks to sort of BHP's cost advantages, but it also speaks to perhaps that, you know, some of these commodities are still performing okay despite all the noise. So there was a fairly mixed picture from BHP about the outlook in China. As you said, they did highlight the ongoing contraction in the property sector. Mike Henry, the CEO, mentioned that 20% of steel now goes to construction. That's way down from like 35, 40% in previous years. But at the same time, you know, there's other segments, just to go back to your question, there's other segments which are taking up some of the slack. Machinery, equipment, some infrastructure spending, transport and cars is obviously a major part of steel demand. And those aren't helping, I suppose, to blunt some of the worst impact.
And just how bad is the crisis in Chinese steel, particularly when we're seeing headlines like we had from yesterday in Canada, where you're seeing trade barriers being erected? How challenging is this going to be for China?
Well, you know, there have been trade barriers being erected against steel in waves going back 2 decades. This is just the latest. There has been a surge of Chinese exports this year, perhaps not on the scale we've seen in previous times. We talk about steel crisis. Certainly, there's a big contraction in demand from construction, and the unusual thing about this particular slump is it doesn't seem to be much immediate relief from it. Again, BHP talks about the market perhaps bottoming out, but not until next year. And there's no kind of major stimulus. There's no prospect of another, like, you know, big construction boom as we've seen in the past. So this is why you've heard the CEO bigging up copper. All the big miners like to talk more about how much copper exposure they will have. And again, he was a little bit sanguine on short-term prospects for copper, alluding to a slowdown of perhaps down to 1% to 2% growth in China from 6% last year. But again, like everyone else, talking up the kind of long-term boom from renewables, etc.
All right, Bloomberg Commodities reporter Martin Ritchie walking us through the BHP story here, seeing it higher in today's trade as well. So we're going to keep an eye on that, despite the fact that they did actually cut their dividend for the reasons that Martin kind of outlined there. There's another story that we're watching, of course, which is what's going on in the oil space. You are seeing some marginal gains there when it comes to Brent crude, although now pared back. And 81 handles what we've got an eye on. This is related to the Libya story. The Eastern Libyan government is talking about shutting down some of the oil production, the oil exports. But just to put this into context, Libya only makes about 4% of OPEC's oil production broadly. So there is a thought that even though it did actually gain in yesterday's session to the tune of about 3 to 4%, pared back the move because it doesn't actually have that much of an implication to broader markets. That's really just a function of this Eastern Libyan government using this as a mechanism to threaten what the rest of the country is doing as well. We're going to dive into the EV story next. Stick with us. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as, moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
Volkswagen has more strength on globalization, quality, manufacturing, and supply chains. We have more advantage on artificial intelligence, software, and electrical and electronic structure. So I hope we learn from Volkswagen's strength to make up our shortcomings.
They're the chief executive of XPeng, the Chinese EV maker, talking about the partnership with Volkswagen, where, of course, Volkswagen has the know-how of building large volumes of cars through many, many decades, and they have the know-how in terms of AI and digitalization and the inside of the EV and the car, hence that partnership. XPeng is also a company that is facing now 21% tariffs to sell their cars into the EU, which is supposed to be a key market for them. So we wanted to check in on how sort of Chinese EV deliveries have been going so far year to date. When you look at the different regions, you see a very clear story here. When you look at what's happened year-to-date change in Asia, EV sales from China are up 36%. You look at Latin America, we're close to 500% change year-on-year, year-to-date, in terms of the number of EVs that are being delivered. When you look at North America, where we know the Biden administration has thrown up trade barriers of 100, 125%, that is not happening there, down by a quarter. In Europe, similarly. But when you look overall, despite all the things you're seeing and the difficulty China's having in the U.S. and in Europe, up 17% year-to-date, and just in the month of July, up 14%. So really, this is sort of a key conversation going forward here, and I think also in the inflation story, Kriti.
It's a fascinating one, and of course, this also comes off. You mentioned some of the other regions. Canada, I think, is in the news most recently, in terms of hitting China with those tariffs. I'm looking at these numbers, though. 100% levy on electric cars, 25% on steel. Now, Bloomberg had reported this previously, but this is now officially confirmed. I think we're getting the Chinese response this morning.
We are. Understandably, they're upset about this.
Yeah.
Is it too late to avoid a global trade war? Are we already in a global trade war? If we're not in a trade war, are we in a subsidy war? The IRA obviously is needing to be folded into all of this. If we get Trump, do we get a trade war? If we get Harris, do we get a subsidy war? It does feel as if we are shifting into a much more aggressive phase of this process, and there's quite big tectonic moves that are taking place here. The Chinese clearly are pushing the EV story. Are the Europeans trying to encourage domestic production, or are they simply trying to encourage the Chinese to build their production in Europe? I think there's some really difficult questions that need to be answered.
One that, and you'll know about this quite well, one that it doesn't feel like the market is necessarily taking into full account. And you saw then pieces of it. I think you've done the reporting on things like pork and dairy, et cetera. You're seeing that show up in Europe. But this is not a 2020 redo in terms of pricing in that kind of trade war or that subsidy war, as Guy puts it. There's still kind of a wait-and-see approach to this.
Absolutely. And again, we still wait to see how China is going to respond. Of course, the trade balance is steeply tilted in their favor. So there's a limited capacity of what they can do in terms of the European, but they can still make it hurt. And the question is going to be, as we alluded to a little bit earlier, to what degree will the economics trump the politics of this? And I think what we've learned over the last few years is that actually politics are a lot more important than economics than we had assumed in sort of pricing in the sort of idea of peace through trade.
Let's take it through the German lens.
Yeah.
German economy is really struggling right now. We saw that. We spoke to IFO yesterday. Really difficult situation, evolving and continuing to worsen, according to IFO. China is a key part of that. Is Europe willing to sacrifice the German auto industry at the kind of within this trade war? What is Europe willing to do? What is it willing to protect? What is it willing not to protect? In order to go forward from here, is it trying to protect the auto industry? Is it trying to encourage the Chinese to come in and just build here?
I think it's both, right? Yeah. But I think that when you speak to the executives within the German auto industry, the way that they see this is they have basically 2 to 3 years to really get their competitiveness within Europe under control before the Chinese have their own production facilities within the European trade barrier and in Hungary.
But then you've got to think about the German manufacturers as well, having a huge footprint in China, which is at risk as well.
Yeah. Well, who better to speak to about this than the former EU Trade Commissioner, Cecilia Malmström, who's also a non-resident senior fellow at the Peterson Institute for International Economics. Thank you so much for joining us today. I mean, I guess the question is, after we've seen what we saw from Canada yesterday, are we already basically in the foothills of a trade war? Where do you see this ending?
Well, I hope we're not in a trade war, because that would be bad for the global economy. But of course, we have a problem with the Chinese subsidies in EVs and other items. The EU has imposed preliminary tariffs on EVs between 9% and 36%. They will then be formally adopted by November. And the Chinese have other anti-subsidy investigations as well in the dairy industry, in pork and cognac, I think. So they will retaliate. But I hope it stays there so it doesn't escalate further, because we don't need trade wars in the world right now.
And of course, the Chinese, what they will say, and what they have said to a number of these, is that actually they are legitimately outcompeting the Europeans in terms of the products. And I think that there is, obviously the Europeans are very quick to say, no, it's actually all to do with subsidies. There's got to be some truth somewhere in the middle. How does Europe become more competitive in dealing with some of these issues? Because that is something that they also inevitably need to deal with.
Absolutely. And the dilemma here is that we need those Chinese cars. We don't have enough EVs at affordable prices, high quality, in Europe. So that is why we have not imposed 100%, because we don't want to stop the imports. We just want to slow down so that Europe can catch up. And that is ongoing discussion right now. How can we support European car industry and make them catch up with the Chinese. Right now, there is a little bit of a vacuum in the European Union. We are waiting for the new commission to be installed. There is no government in Paris. We have discussions in Germany. So it's hard to make decisions about this. But they still definitely dominate the whole autumn discussion in the European Union.
Valdis Dombrovskis does not want to be the trade commissioner anymore. He picked up that from Phil Hogan when he stepped aside. Who do you think? Have you got any names? What are you hearing? Who should be the next commissioner?
I don't know. I hope that it is someone who can see the value of open markets, of free and fair trade, but still be tough when needed. There are lots of speculations. Not all countries have nominated their commission candidate yet. So we'll see.
Are there any names that you think would be? Okay, you've done the job. You've talked about the skill set necessary. Are there any obvious candidates that you think stand out who could fill that role?
I don't see that immediately right now, but we don't have the full list of candidates. Big countries like Poland and Italy are still to nominate their candidates. So let's see.
Well, let's bring it back to and focus in on the European question, though, and you highlight the need in previous pieces that you've written as well, this need for free trade agreements that perhaps maybe take some of the pressure and some of the dependency off the likes of China and the United States as well. But it comes into direct conflict with some of the far-right governments that we're seeing kind of add pressure in Europe, who are looking more inwards, who are looking for that protectionism. How does the EU fight that? In your former role, how do you push back against that from an economic perspective?
Well, you have to make the case all the time as a commissioner, but also member states. You need to explain to the citizens, you need to explain why this is important for our prosperity, for our growth, for our interaction with other countries. And with the uncertainty of the outcome of the American elections, we don't know who will be in the White House independently. Of course, US is a partner, but it can become even more tensions on trade. So we need to expand even broader. We have trade agreements with most countries of the world, but there are still others to be made and to be developed in Latin America, with India, and with the whole Asia Pacific. We have individual trade agreements, but we should be more involved there and try to find partners and allies, both in the car industry, but of course there's so much else, for instance, in the whole green technology.
Well, so I want to zero in on the U.S. conversation in particular, because of course we know right now, until the U.S. election is sorted and we get a new president in the Oval Office, there is a question of what happens to the steel tariffs that have been put on pause right now. And in the absence of that decision, the United States has chosen to do quotas instead on the EU. And I'm curious about that mechanism. Using quotas in place of subsidies or tariffs, is that a friendlier kind of tier 2 version of this this global trade war? How do you deal with it? Are you more open to that? Your thoughts?
Well, those quotas need to go. I mean, the tariffs were illegitimate from the European point of view, and quotas is just something that we have agreed upon while trying to find an agreement in the working group that is dealing with the steel and aluminium tariffs. That was stalled. This is something that has to restart again as soon as the elections are over. There's a new president in place, and there's a new administration and a new commission in place in Brussels, which will happen probably in November.
And Cecilia, I have a slightly more sort of philosophical question for you about sort of globalization and trade. Did we over-globalize, right? Because for a very long time, it was very taboo to talk about this sort of thing. It was something that was relegated to the sort of populist fringes. But more and more, you see it in mainstream policy. You see it with Joe Biden. You see it in Europe, saying that we need to bring manufacturing back. And actually, we're willing to subsidize to that effect. My question, I guess, is how do you preserve the benefits of globalization without having as much of the punishing consequences as well? Can you actually do that?
I think you can, but you need to put it in a broader context of social policy, tax policy, different income policies as well, in order to make sure that people who are losing out of globalization get compensated and that they can have a chance to come in via training, education, and so on. So this is a very strong political leadership needed here, and we have seen that lacking in the US, in Europe, and elsewhere in the world as well.
Lacking leadership, but also lacking the funds, it seems, Celia, to add on to all these points, especially when we talk about that subsidization. We were just talking with the head of the French business lobby earlier in the program, who was saying we would love to be able to match the kind of subsidies and help that the U.S. government provides, incentives provides, but there's no money in the budget to do it. Given that the EU is about to come on to some really tough budget talks, I'm curious if that's the next step that, from a trade perspective, you need to see from these European governments, finding the incentives and the subsidization within some of these domestic politics.
Well, that is a discussion that will continue during the fall. Some countries are very much in favor of raising the subsidies. Others are against, not only for economic reasons, but also for ideological. If we are creating a subsidy spiral in the world, it is not going to end well. It is going to lead to increased conflicts between countries and between the rich world and the poorer world. We have seen that before in history, and it's not going to end well. Some subsidies are needed, but what we need to do is to sit together together in the world and find ways of defining what is a good subsidy, because sometimes there are good subsidies, obviously, and what is a bad subsidy, and how can I subsidize without hurting my neighbor? And that discussion must happen in international forums, in WTO, in G20, G7, or what have you. And but we need all the partners to sit around the table: Europe, US, and China. And with all the actions going on right now, I don't see it's happening this year, but hopefully. We need rules on this.
And you were EU trade, yeah, and you were EU Trade Commissioner, quite notably when Trump came into power. How do you think that the Europeans should prepare themselves potentially for another Trump administration? How should they go about things differently in order to get a different outcome this time around?
Well, I think they're looking at different scenarios. Obviously, USA is an important partner and a friend, and we need to cooperate whoever sits in the White House. But we need to prepare, and that's why we also need allies. If there is a massive wave of new tariffs, 10, 20% all across the board, of course, Europe and other allies will have to retaliate. But it has to be done in a measured way, in a WTO-compliant way, and in a collective way. And then we need to find ways where we can cooperate on critical minerals, on some things on China, for instance, we can do, and on the green transition. And I think there are lots of there are different scenarios being drawn up now, but obviously it's the American people who decide who's going to sit in the White House.
Yep, and we've got a choice. We can either get Harris or we can get Trump. If we get Harris, Cecilia, do we get more subsidies, which are tough for Europe? If we get Trump, do we get more tariffs? Is that how we should think about this?
Maybe that's one, but it's more complex than that, obviously.
Okay. But in broad terms, it kind of feels about right. Cecilia, great to catch up. Thanks for the time this morning. We'll look forward to having more conversations with you as we count down to the US election. Cecilia Malmström, the former EU Trade Commissioner and non-resident Senior Fellow at the Peterson Institute for International Economics. Thanks very much indeed. What are we going to talk about next? We're going to take you to what is happening in Ukraine and the Kursk region of Russia. The IAEA chief is leading a risk assessment trip to Kursk, the nuclear plant there, very much at risk, we understand. We've got fighting going on in the region. We've got an update on what is happening and that trip. That's next. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
47, nearly 48 minutes into the equity market session this Tuesday morning. This is what we are looking at, a fairly quiet session. Volumes have picked up a little bit. London is bouncing back, coming back, I should say. It was out yesterday, as a result of which you see that volume coming back in. You've got the BHP story to fold into the commodity story this morning, so you're seeing the basic resources tracking a little bit higher. That is where we're seeing the outperformance. Faded down a little bit. We're up by 1.1% on basic resources. Groceries are doing reasonably well. The food and beverage sector is doing very well as well, relative to the overall market. That tells you this is a cautious market. It also reflects maybe some of the tech sell-off we saw yesterday over in the United States. So that's the kind of the market picture this morning. It is quiet out there from a market point of view. We are mid-August. Think about this week as kind of the Christmas week, maybe, in terms of how the summer is progressing. We do have a video on Wednesday, of course. Let's turn back, therefore, to the geopolitics and talk about what is happening there. The head of the UN's nuclear watchdog says he is personally leading today's mission to the Kursk nuclear power plant in Russia, given the, quote, serious situation. He spoke to this program last week.
They do not have a protecting dome around them, which means that the core, the reactor's core, is pretty exposed. And when you add up this fact to the issue that you have advancing troops, objectively speaking, within artillery range, then this, of course, is a source of enormous concern to me and for the agency.
Director General Grossi warning of the risk and how exposed the Kursk plant is to the fighting that is going on around it. It doesn't have that protective concrete and steel dome. Let's talk about what we should expect from this trip. Bloomberg's Jonathan Tyrone joins us now to discuss this. The IEA was warning, Jonathan, last week of a Chernobyl-style accident, the potential for it at this Kursk nuclear plant because of the lack of protection. What is the objective, therefore, of this visit that we are going to see today?
Well, Grossi just landed at the Kursk nuclear power plant about a half an hour ago. Basically, the IAEA is there to bear witness. There are liability issues if something does happen. Both sides have maintained over the course of this 2.5-year war that nobody wants to provoke a radiological incident. That would be very costly to Russia, which remains the world's biggest exporter of nuclear technology, nuclear fuel. Obviously, Ukraine has suffered under a radiological incident. It has more than 2,600 square kilometers of an exclusion zone around Chernobyl. The issue here is the reactors that are in Kursk and are operating are the same RBMK model that melted down in Chernobyl. These are reactors without a secondary core, these massive steel and concrete structures that are meant to contain radiation in the event of a meltdown. No other country in the world would operate this kind of a reactor. They are outdated and have severe engineering flaws.
So walk us through then, if these risks are so big, what is actually expected to come out of the meeting itself?
Well, the IAEA is limited. It's actually pushing the boundaries of its mission by even putting nuclear safety monitors in places like South Ukraine nuclear power plant, in Zaporizhia. Conceivably, Russia could ask the IAEA to set up a permanent mission in Kursk to monitor any events, stray rockets, stray UAVs, because if an accident does occur, and we're talking about a very narrow margin of error, the Russians in particular will want to have an independent monitor declaring who bears liability.
Jonathan Tyrone. He's our sort of in-house nuclear expert here at Bloomberg, joining us from Brussels. Thank you so much for your time today. Listen, we talk about the nuclear risk within the situation with Russia and Ukraine. There's also another risk that I think we saw yesterday, which was that Poland had said that one of the Russian drones had entered their airspace after that levy, that surge of attacks of cruise missiles and drones. Is that something that comes back into the conversation, particularly as Ukraine turns up the pressure by its invasion and sort of entering into Russian territory? To what degree does that move the conversation forward? And as well, obviously, the energy conversation, where we see that a huge amount of their infrastructure has been destroyed, and of course, as we know, heading into the winter, very critical moment for Ukraine.
From a European point of view, the energy infrastructure is absolutely critical. From a Ukrainian point of view, it's obviously critical as well. But from a European point of view, some of the fighting is getting close to some of the gas transfer stations. It's getting close to some of the storage stations where gas is being stored. European traders, therefore, are backing away from that, which is raising the price. This is where potentially the risk lies for Europe this winter. We're coming out of summer, we're going into winter. The moment things look all right, we're already seeing some volatility in the gas price, though.
And we got lucky, I think, last 2 winters here, because one, there was extra supply, and then the temperatures weren't as bad either. So it cushioned that. Do we see the same this winter? I think the point you make about the drones is really interesting on Poland, because when we had that conversation with the IAEA Director General, he was making the point that you can't actually, and of course he's doing this as a third party to bear witness, as Jonathan said, but they're hesitating in terms of actually pointing the finger at who's behind this and using the fact that they are unmanned drones as mechanisms, or as evidence of the fact that you can't actually track them down. I thought that was interesting, the fact that it is drone warfare that now seems to be driving that risk.
Yeah, it's a huge risk. This is the thing, the margin for error, as we were just hearing.
Yeah,
that's where the challenge lies here, and making sure that when we're dealing with a nuclear power station here that has little protection, and you've got drones, you've got artillery. As we were just hearing, the margin for error is tiny here. This is a huge risk on Europe's doorstep. We saw what happened with Chernobyl. Are people painting that kind of risk? Is this a risk more sort of commensurate with what we saw in Fukushima? Obviously, there we saw containment, but is that risk greater than that? These have been huge events that have shaped European energy policy in a big way. Fukushima basically took Germany out of nuclear power,
and willing to do so in the midst of their biggest energy crisis maybe in history. Yeah.
So these are critical events, not in terms of just what would happen in terms of the radiological release, but in terms of how energy policy will be shaped as a result of it as well.
Does this increase the appetite for nuclear energy, or decrease?
I don't know. That's the problem. We don't know. It has had a material impact on policy in the past. I'm assuming it would again. Anyway.
So there's a lot going on in geopolitics, of course. We're going to keep you apprised of the situation in Ukraine, arguably the Middle East as well. We haven't even talked about the Iranian component of the nuclear conversation as well. We should talk about, I think, going into tomorrow in the back half of the week, which, Guy, to your delight, will be perhaps a little bit more exciting, going into NVIDIA tomorrow.
Going to get exciting.
PCE on Friday. Guy's going to get really, really hyped. He's going to throw a Santa hat right out the window. I'm curious, though. I still feel like Apple is the story. That's the exciting one for me, at least today.
Why?
Going into NVIDIA. Well, okay, so the CFO has taken a step back. We know that. But I actually think it's their, and I'm usually not someone to watch product launches this way, but you've made this point very well, that Apple has been behind the game when it's come to AI, when it's come to et cetera. They're launching their iPhone September 9th.
I thought it was September 10th, and then I was going to ask you, what are you going to watch, the launch or the debate?
Well, luckily, the debate is September 10th and the launch is September 9th. So that's what I'll be watching. And just to hand that out, as well as this private equity event in Paris as well as September 10th. Very exciting. We'll be there.
You got a lot going on in that period. Things are going to get more exciting. The back end of the week is going to be much more interesting. We are going to watch, obviously, and we're going to count you down to the NVIDIA event. Ed Ludlow's got an interview. That's going to be amazing. I really can't wait to see what Jensen Huang has to say and the kind of tone of the conversation that we get with him. There are concerns around maybe some of the Blackwell chips being a little delayed, but as we were hearing from Mark Cudmore a little bit earlier on this program, it doesn't feel like, even if you get a miss, it's going to be a material miss. It's going to be a miss that can be caught up later. But expectation.
Is this what we call a dovish cut or a dovish?
I think if you think about it as a central bank kind of event, maybe. But I don't know. The market clearly has shown that it can deliver significant volatility. We saw that at the beginning of this month. Could NVIDIA provide that catalyst again?
But the PCE on Friday, so then whatever shakes out on Wednesday, Thursday, does it just reverse on Friday? We tend to see that.
I'm waiting for September the 6th. The payroll number is the big number that we got to wait for.
That's true.
That's going to determine ultimately whether or not the Fed delivers 25 or 50. Anyway, that's it for the opening trade. That wraps it up for us. I'm going to continue. The Pulse is next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
European stocks continue to gain despite actually some tech concerns weighing on Wall Street last night. Investors very much now waiting for the NVIDIA earnings Wednesday after the bell. We need a little bit of clarity on the AI boom and where it's going. BHP shares gain in London. The world's biggest miner plans to zero in on its copper portfolio as China's appetite for steel fades. Plus, Russia launches a massive air assault against Ukraine and its energy infrastructure. Meanwhile, the UN's atomic watchdog heads to a nuclear plant in the territory seized by Kyiv in the Kursk area, warning of a potential Chernobyl-like incident. We'll talk about all of these issues throughout the next hour. Let's start off with the markets, though, and talk about what is happening this Tuesday morning. London was closed yesterday. It comes back. We see a little bit of volume, therefore, creeping back into this market, but it still feels quiet. We're coming to the end of August. We're waiting for the next big catalyst, likely to come Wednesday after the close with NVIDIA. But at the moment, it's not exactly a bright green picture here in Europe this morning. London up by 0.8%. Mining stocks in particular are doing well. Let's talk cross-asset, what we're seeing. Nasdaq futures up a little tick. We saw them selling off yesterday. The US 10-year, 3.819. So we're seeing a little bit of an offer coming into the bond market today. We're waiting for big data at the end of the week. Core PCE Friday, the second two core PCE. Basic resources are up. Brent's a little softer this morning, but has been rising. So the oil stocks are doing reasonably well this morning. In terms of the stories we need to focus on, well, it is the countdown to NVIDIA. NVIDIA that we're watching. But do rate cuts mean rotation? Maybe there was some evidence of that in the US market. We'll talk about that next. Sharon Bell is going to join us from Goldman Sachs. So let's get into it.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Tuesday, good morning. I'm Guy Johnson. I'm in for Francine. This is The Pulse. Let's talk about what we're seeing in terms of the European stock market story this morning. We're ticking up a little bit. Still feels fairly quiet. We are digesting Jackson Hole. We continue to kind of think about what is happening there. But we're really counting down to the main volatility of the event of the week, which, of course, is going to be the NVIDIA earnings tomorrow. As I say, Sharon Bell, Senior European Equity Strategist at Goldman Sachs, sitting around the table with me this morning. Good morning, Sharon. Nice to see you.
Hi there. Good to see you.
Rate cuts are coming. Does that mean I rotate into different areas of the market?
Rate cuts are coming, I agree. Although you're saying it, everyone's saying it. It's the expectation. So you'd think that the market would have already rotated that way in expectation of rate cuts. I think that's why, after the correction we had earlier in August, we have seen markets bounce again. Because they now believe that actually the Fed is going to come in, cut rates, not too worried about inflation. I think to get a real rotation into, say, more cyclical stuff, which have performed really well at the beginning of the year, but sold off in the last few months on weaker, more mixed economic data, you'd have to see a view that the economy was picking up more broadly, including China and other places, rather than just rate cuts.
So it's interesting what rate cuts are signalling. The market seems comfortable with the idea that the Fed can now deliver a soft landing. That seems to be the takeaway from Jackson Hole. The kind of the soft landing narrative is in place rather than something more dangerous and concerning.
Yes, I think that's probably fair, and that would be our view as well. I mean, we think that the chance of a recession in the US over the next 12 months, we put it at about 20%, which is a little bit higher than normal, but really not very much. It's certainly would be far from our base case that you get recession. So we feel that the markets are right to start pricing in a slightly softer landing rather than a weaker one. That all being said, is that really enough to kickstart cyclicals? If it's just a soft landing but not very good growth, then maybe you want to more broadly diversify and not just be in, say, more cyclical economy-geared sectors.
If you do see rotation, do indexes come lower?
You mean rotation out of tech and things like that? Yeah. I mean, I do think tech has got its own drivers. You know, as you mentioned before, it really matters what happens to earnings. We get earnings this week, for example. So I think for tech, what really matters is that. If you saw a big change in interest rate expectations, maybe that would make a difference. But generally speaking, I think tech has got its own drivers, and that's really individual earnings and expectations in AI and that space and that sector. I think for a broader rotation in the market, you need to see this narrative of soft landing shift. Either growth was going to be just much stronger, or alternatively, the soft landing no more, and we go into a deeper downturn. So as long as we're in this kind of mixed environment, I think it will just be a bit more of a mixed picture in terms of who performs.
Do you think we see another big volatility event between now and Christmas? Do you think volatility has subsided and will stay down?
Yeah, there's always a risk related to the fact that the US market is expensive versus its own history and very highly concentrated in 5 or 6 companies. And that always creates an additional risk. Even if you take the biggest companies, their volatility on individual days can be 10 or 15%. That's not normal to see companies sell off or rise that much on individual days or weeks who are that big and that large portion of the market. So always bearing that in mind. So the economic backdrop, I agree. If you just told me, you know, this is the economic backdrop, no recession, interest rates coming down, I'd say volatility can be well capped on the upside. You won't rise again. But if I look at the constituents of the market and the valuation, I'd say that's a little bit riskier.
I'm looking at the PMI data out of Europe, and it's telling me a fairly bleak picture. I spoke to the IFO Institute on this program yesterday, telling me a bleak picture about what is happening at the heart of Europe in terms of the manufacturing story. Where's the opportunity in Europe around that?
Yeah, it's interesting, isn't it? And we've had sort of detail of German second quarter GDP, and investment looked incredibly weak in Germany, which is, you know, what I'd expect, given the sort of confidence data that you see out there. People don't invest if they're not confident. The PMI surveys are a reflection of that lack of confidence. They're particularly weak in one area of the economy, which is manufacturing. Services. So the more manufacturing your economy, and Germany is got a big chunk of manufacturing, 20% or more of the economy, it's also the most volatile element of it. The more manufacturing are, the weaker you are, and that's where Germany is suffering. Whereas, say, Spain is growing just as fast as the US, sort of 2.5%, 3%, reflecting its very, very different mix in terms of the economy.
Do you think that services side story, though, is driven by tourism, which is going to run out of a little bit of steam here at the moment? Like, it feels like there's a couple of kind of idiosyncratic stories around Europe at the moment. Services, which has been very strong through this summer.
Yeah.
And you wonder about the sustainability of that, given what we're starting to see, particularly the US consumers beginning to roll over a little bit, the European consumer maybe saving, the German consumer back to that, saving.
Yeah.
A lot of that money has come out of Germany into Spain, but I wonder how sustainable that is.
How sustainable. It's not good the heart of Europe, Germany, has been so weak. So I do think that sort of dislocation, which you're pointing to, between services and manufacturing, it can't carry on being dislocated forever. Yep. I do agree with that. Having said that, I think there's, the consumer in Europe has got quite robust underpinnings at the moment. Yep. Employment is good. Savings are actually much higher in Europe, as you point out, than they are in the US. Yep. So you're not in that kind of credit crunch situation, and the ECB is cutting rates already. So all those things probably mean to me the consumer in Europe stays reasonably strong. But I do agree, manufacturing is this weak spot, and the longer it stays weak, the more problematic.
Is it a challenge to find good opportunities in Europe at the moment? More challenging. You've done this. You've seen cycles. You know what it looks like. Does this feel different? Does it feel more challenging right now to look at Europe and say, there, and there, versus going to the United States and going, we want to put money in these spaces here?
Yeah, look, I think in some ways, I reckon the US is more challenging because you've got 5 or 6 companies, and if you're not in those, and many people cannot,
you're going to underperform.
Many people cannot be full weight in those ones because they end up with their portfolio too concentrated. So in some ways, I'd say the US is more challenging. Europe is on an average PE, totally average valuation, average dividend yield, roughly speaking. Lots of opportunity where some companies are expensive, some are cheap, some have got growth opportunities, some haven't. So actually, I would argue in Europe there's more potential.
Okay. And in terms of entry points, are entry points going to make much more of a difference going forward from here? You've had this period where, as you say, technology, you've had to be in technology to outperform. Entry points kind of in some ways have been therefore important but less of a factor. And I'm wondering going forward as interest rates stay more elevated, as we go through into a kind of new phase, that entry points are going to be more tricky but more consequential.
Yeah, this is a good question. And that entry point after the correction in August would have been a great one, wouldn't it?
Is there another one coming?
Yeah. So I think that returns from here, given the... Look, since October last year, almost a year ago, I think the markets are up 30% or more globally. I mean, that's a fantastic return. You're probably not going to see that in the next year. So to your point, I do think returns overall will be lower. You've got to pick your entry points, therefore. I totally agree. And we have had a bit of a bounce. I'm not expecting a huge underlying sort of return on the overall index from here. Only a few percent. On the S&P, we've only got 2.5% over the next 12 months as a target price. It's not very much.
So do I buy bonds?
Bonds are interesting. They give you a much better yield than you got a few years ago, it's fair to say. The problem with bonds, of course, is that governments have a lot of debt and they will need to issue more. Also, inflation. We just talked about labour markets being quite strong. Inflation is likely to be sticky. Wage inflation is likely to be higher in Europe and elsewhere too than last cycle. So that will probably keep bond yields relatively high, and we think US bond yields will drift up again a little bit, even if at the short end rates are coming down. So I just think it's a trickier overall environment for investors to make a good return.
I got euro dollar at 111, 112. Is that a headwind for European stocks?
I don't think it's huge. You mean the rise in the euro dollar? More recently.
Dollar's been weakening, euro's come back up.
But in the end, I mean, the euro hasn't been super strong in recent years. I don't think that's a headwind at all, actually. I think Europe typically does better when the euro is stronger. The reason it does better when the euro is stronger is because that's giving you a signal about how good the European economy is. So when the euro...
So do you think that is sending a signal about a strong European economy?
I don't think it is at the moment, that is fair to say. All I think is that really what matters is economic growth, and China growth for Europe matters a lot too. And the currency moving 4 or 5%, that isn't really the crucial factor.
Do you think the stability story has been priced into UK assets now, post the Labour government's arrival? Do you think that trade is done? Do you think there's more to come?
I think there may be a little bit more to come there. I quite like FTSE 250, for example, which is the mid-cap index, which is the one that's more exposed to the UK economy. I think that the momentum in their data in the UK is good. The UK is opposite from Germany. It doesn't have a big manufacturing sector, and that means it's just less exposed to those concerns.
Great to see you, Sharon. Always a pleasure. Thank you very much indeed. Sharon Bell, Senior European Equity Strategist, joining us from Goldman Sachs. Let's talk about some of the pre-market stock stories that we're watching over in the United States. Paramount down You can see circa 5%. Bronfman's walking away. Looks like we are going to see the Skydance deal going through. So Edgar Bronfman walking away from that. So basically the price comes down, and that is what you're seeing reflected in the stock story this morning. We're going to talk about another stock story next. BHP expects a turnaround in China's property sector in the year ahead, but plans to zero in on its copper portfolio. The appetite for steel, not great right now. It's plateauing, but the copper story looks more positive and certainly will look more positive in years to come. We're going to hear why. The CEO of that business is Mike Henry. We spoke to him a little bit earlier. That's next. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
We believe that the fundamentals remain intact for China to continue its growth beyond kind of its middle income status currently. They're obviously focusing on high quality growth, and we expect that as they do continue to grow the economy, it's going to mean plateauing of steel over time, a constrained iron ore market, but increasing demand for some of the other commodities.
BHP's CEO, Mike Henry there. BHP, of course, the world's biggest miner. Shares tracking a little higher this morning, both in Australia and here in the UK. This after the mining giant's full-year profit met expectations, despite actually that lower Chinese demand for iron ore. BHP heavily invested in iron ore. It's interesting that the big miners are still making profits, despite the fact we've seen the Chinese slow down. Martin Ritchie joins us now to discuss. Martin, this is a company that is continuing to do well, and this is despite what we're hearing about the Chinese economy. What is their outlook for the Chinese economy and iron ore demand? It's not just the property sector that consumes that. It's the auto sector. It's the manufacturing sector. What is the bigger picture?
Yeah, as you said, a kind of contrast between BHP's relatively positive results and perhaps some of the commentary in the mood in commodities markets in recent months. Look, BHP really spoke to that. The CEO did speak about the headwinds, especially for iron ore demand. He pointed out that the property sector in China remains weak and probably won't bottom out until next year. That's very important because it used to be upwards of a third of China's steel demand. Now it's down to only 20%, according to BHP, which marks a big shift. And then on copper, they did say, demand slowing quite considerably this year to about 1 or 2%, down from 6% last year. And again, that's due to construction. But if you dig a little bit deeper, there's not really a very precipitous slump in China's steel demand. BHP talks about demand plateauing. And you've seen other sectors, manufacturing, certainly cars are a big steel consumer, and other industrial markets, I guess, take up some of the slack. So all in all, they certainly spoke to some of the weaknesses in iron ore, but also some of the long-term strengths in their portfolio, especially on copper going into the future.
Okay, well, let's talk about copper and what happens next. Obviously, we've had the Anglo bids, didn't go through. We're now wondering what happens next. Is the sense that Henry's still interested in M&A, still interested in doing copper deals?
The sense is very much that they're still very interested in copper and increasing their exposure to copper by some means. We did ask them directly, I think, on TV earlier about whether there would be a renewed bid for Anglo, which was seen as one of the major routes, I guess, to increase that would have made them the biggest copper miner in the world by large margin. I think his reply was essentially that wasn't plan A for their copper business. They were not counting on that and nothing else. There's a focus on trying to expand the assets they've got and perhaps looking at other deals opportunistically. Whether they go back to Anglo in November, when I think they're allowed to under the UK takeover rules, is another question. It remains a very complicated transaction.
Is it in past cycles, when China rolled over, the miners rolled over and were sort of unable to deliver profitable growth? This time round, we're seeing the miners able to deliver profitable growth, even as we see a Chinese slowdown. What are they doing differently this time round that they didn't do in the past?
BHP and Rio and the majors have always been making money with iron ore prices, in the last, say, 10, 15 years, because they have such a low cost position. They have grown so large, and their costs for producing from these vast mines in Australia are extremely low, and that's the same principle broadly applies to copper. So even though prices have come down by a fairly big chunk, especially with the iron ore, they're still making a lot of money on that. They're still making very fat margins. And then on copper, prices are actually up this year. All the kind of negative commentary set aside, the market is still growing and prices are still relatively high, and that helps a kind of low-cost miner like BHP.
Martin, great to catch up. Thanks for the update. Really appreciate it. Bloomberg Commodities reporter Martin Ritchie joining us on BHP. Let's turn to one of the other commodities we watch, of course, and that is oil. You are seeing a little bit of a fade in the move we saw yesterday. There was concern in the market yesterday surrounding Libya. The market seems to have kind of once again come to the conclusion that actually this isn't a bigger factor that we thought it was initially. You get the kind of the headlines coming through about concerns about supply. The market's getting used to that Libyan story and therefore is working around it. The story that really stood out for me in oil yesterday came from Exxon, which sees 2050 oil use at current levels, despite our net zero goals that we currently have. And that tells you a lot about kind of where investment will still need to be made in order to provide the supply. And if that supply weakens off, you could see prices going significantly higher. So I think it was fascinating what Exxon had to say yesterday about the outlook story. Anyway, oil this morning fading a little bit. Let's turn to the new oil next. We're going to talk about what's happening with tech, a roundup of some of the day's top tech stories, including Mark Zuckerberg claiming that Meta was pressured by the White House to censor comment during the COVID pandemic. We'll talk about all of that next. This is Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We're about 34 hours away from the NVIDIA numbers. It's going to be the big event of the week, so it's probably time we talk tech. Let's start off actually talking about what's happening with Apple. Apple has sent out invitations for a product launch event. It's going to happen on September the 9th. The company is expected to announce details of the new iPhone 16. The theme, though, of the event is apparently glow time. This, we understand, is a reference that we're going to be hearing a lot more about regarding the interface that is going to be used by the new Siri digital assistant. AI is going to be a big feature of the landscape. We're going to get the new 16. I think we're going to get some new sort of peripherals as well. I think they're going to get an update also on the Apple Watch. Meanwhile, Apple says longtime CFO Luca Maestri will be stepping down as part of a planned succession. He is going to hand the role to his top deputy Kevin Prakash. That is coming up. We'll look forward to the impact that that could have on its numbers. Telegram CEO Pavel Durov is being questioned in France over claims the messaging service failed to properly fight crime on the app. The Paris prosecutor's office is looking into allegations including refusing to help authorities run legal wiretaps on suspects and enabling the sale of child sex abuse material. Meta CEO Mark Zuckerberg says the White House, quote, pressured the company, the social media giant, to censor content related to the COVID-19 pandemic back in 2021. Zuckerberg adding that he regrets not being more outspoken about this in the past. It comes, of course, amid growing global debates over how social media companies should be policing content posted by their users, which takes us back to that Telegram story. We are going to be hearing from the NVIDIA CEO tomorrow. That's going to be fantastic. We want to hear about that. Up next, we're going to talk about what is happening in the Kursk region. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before. And it'll never be done again. when you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famed, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We're approaching half past the hour. Welcome back. You're watching The Pulse. I'm Guy Johnson in London in for Francine Lacqua. Let me just update you on what our key stories are this Tuesday morning. European stocks edging a little higher. Despite tech concerns weighing on Wall Street last night, investors are clearly now waiting for Nvidia earnings, which come after the bell Wednesday. In the commodity space, BHP is gaining in London, the world's biggest miner, planning to zero in on its copper portfolio. This is China's appetite for steel under a little bit of pressure. And Russia launching a massive air assault against Ukraine and its energy infrastructure. Meanwhile, the UN's atomic watchdog heading to a nuclear power plant in the territory seized by Kyiv recently. We're talking about the Kursk region. The IAEA warning about a Chernobyl-like accident and the potential for it in that region. So let's get more on that last story. The head of the UN's nuclear watchdog has now arrived in Russia, in the Kursk region. He's heading to the Kursk nuclear power plant. He may already be there. We are watching for updates from the TASS agency, the state-owned Russian news agency. The head of that visit, Rafael Grossi, spoke to Bloomberg last week, reiterating his concerns about the risks surrounding this nuclear plant.
They do not have a protecting dome around them, which means that the core, the reactor's core, is pretty exposed. And when you add up this fact to the issue that you have advancing troops, objectively speaking, within artillery range, then this, of course, is a source of enormous concern to me and for the agency.
Rafael Grossi speaking to me last week. Joining us now, Bloomberg's Jonathan Tyrone, updating us on what is happening here. So, Grossi warning last week about a Chernobyl-like accident that could happen because of the lack of protection at this Kursk nuclear plant. Talk about what is happening this morning. Is Grossi already there? What is he expecting to find?
Well, Grossi's there. What he's going to find is Russia presenting the evidence it's compiled. They've been accusing him for months that unmanned aerial vehicles, rocket debris has been found near the site of the plant, near spent fuel ponds. The fact is, this is a sprawling facility. It has 2 reactors that are being decommissioned. It has 2 reactors that are in operation, and it has 2 more highly valuable new reactors that are under construction. It's highly unlikely that Grossi himself or his team will be able to see everything on this trip. So the best that he'll be able to do is open lines of communication with the plant operators, assess the evidence that is presented, and perhaps build a monitoring mission moving forward as long as this plant is in the front lines of the war.
How big a risk does this plant represent? How worried should Europe be?
Well, look, I mean, Grossi himself invoked the 1986 Chernobyl accident because the RMBK reactor design in operation in Kursk is the same Soviet legacy design that was in Chernobyl. So, you know, it's a fundamentally flawed design by modern standards where safety is highly prized because it does not contain this, you know, massive steel and concrete dome that sits over every modern reactor and is there to contain, you know, radiation in the event of an accident. If something were to happen to the core, then it would be hard to contain that radiation. That being said, you know, this is a target-rich environment. There's not just the reactor core. There's spent fuel ponds. There's the operating center, and you know, there's this, you know, multi-billion new reactor that the Russians are building and want to bring online. In fact, at the beginning of 2025. So, this is, you know, a large and complex site that does pose danger because of the narrow margin for error in the middle of a conflict zone.
Jonathan, thanks for the update. We'll continue to watch for those updates. Thank you for joining us throughout the morning. Jonathan Tyrone joining us on what is happening in the Kursk region this morning. I want to take you to China. Jake Sullivan, the National Security Advisor of the United States, is meeting the Chinese Foreign Minister Wang Yi in Beijing. He landed a couple of hours ago. We are going to see the more significant of formal meeting taking place tomorrow. But you're looking at live pictures coming out of Beijing as Jake Sullivan arrives in China. I want to take you back to the Kursk region, to what is happening in Ukraine right now, though. Another event that we're going to be watching out for this morning, the Ukrainian President Volodymyr Zelensky is going to be holding an extended press conference today. He's been indicating over the last couple of days that the country's energy infrastructure has suffered significant damage. This after Russia fired more than 100 missiles and nearly as many drones at power facilities across the country yesterday. The latest attack, of course, comes as Kyiv continues its incursion into the Kursk region. We were just mentioning that part of Russia. Joining us now, Elizabeth Braw, who is a senior fellow at the Atlantic Council, joining me around the table. Good morning.
Good morning.
So we have a nuclear facility in the Kursk region that looks like it represents a major threat. We have a dam near Kyiv that is being maybe not targeted, but is in certainly significant jeopardy. What is the risk that we see? How high is the margin for error right now? How much risk are we running here that we could see a major event which could have a significant impact on the tide, the way that this war is going?
The risk is that any of these energy facilities or power facilities, even if they don't all collapse, if one collapses or is damaged, then that is a major calamity in itself. So if you look at that dam, for example, if it breaks, even if it wasn't deliberately targeted, if it breaks, that is hundreds of thousands, if not millions of people who will be affected, and we see that sort of attack constantly happening now, of course, in concentration, because Russia is trying to turn the tide and also turn the narrative of the Ukraine war, showing that it has the initiative and it's not too ashamed to target energy infrastructure, which is a very frightening position for the rest of us to be in.
Does it have the initiative?
It's trying to show that it has the initiative.
But does it? Do you think it does?
It does in some areas, but what Ukraine has managed to do in the Kursk region is to show that even though the sort of official front line is to Russia's advantage at the moment, Kyiv or the Ukrainians can think innovatively and create an advantage for themselves. So that's why Russia is on the back foot and again isn't too embarrassed to target energy infrastructure to show that it has the initiative.
Does Russia care about how the rest of the world perceives these attacks?
Not at all. And that is the frightening thing about this war. Ordinarily, you would see two warring parties try to stick to the rules and what is considered respectable warfare. Russia, by invading Ukraine, has demonstrated that it doesn't care about global public opinion, doesn't care about international laws and rules. And that's why it has this enormous freedom to do what it likes, because it has essentially already said, we don't care what you think, and we'll keep going along those lines.
Ukraine is indicating that it is being held back. That it is being held back by the rules and regulations that are being put on the use of weapons that are being provided by its Western allies. Is that a fair point?
the Ukrainians have a point in saying, as they do, that it's not fair that they should have to stick to not just international rules, which any respectable country would want to do, but also the rules that Western donors have imposed on it for the use of the weaponry that the West is donating. And the Ukrainians are saying, why is it that Russia gets to strike wherever it likes within our country, but we are limited? And it's also making the comparison with Israel, which doesn't have such strict rules imposed on it by the countries that provide it with weaponry.
Israel has learned the lesson that you ask permission later. You do, and then you kind of retrospectively kind of get the clearance, particularly out of Washington. Is Ukraine learning that lesson as well?
The Kursk incursion is a very strong indication of Ukraine learning that lesson. It didn't ask for permission, and it certainly didn't coordinate the incursion. It just did it. And then what were Western donors going to say afterwards? They couldn't very well say, well, you shouldn't have done that. So they sort of went along with it, even though they were not involved in the planning or asked for permission. And I think we may see more of that.
I was about to say, does that tacit acceptance by the donors encourage Ukraine to do more of this?
I think it will, and we've already seen Zelensky being very clever. For example, in asking for donations, he says thank you in advance before having received the donations, and so now he clearly said we'll go ahead and then we'll ask for permission after we've already done it, when they can't very well deny us the opportunity to do it. So I think we'll see more of this, also because it really isn't fair for Ukraine to be bound by these rules when Russia proceeds with impunity.
Is Ukraine in a rush to do what it can do before Trump arrives potentially in the White House?
Ukraine is in a rush for several reasons, not just the U.S. election, but also the U.S. election. It's in a rush also because it is under duress when it comes to the supply of soldiers. It can't just sort of conscript or recruit prisoners out of prisons. It's not what a respectable country does. Russia does it. Ukraine can't do it. So it is running low on soldiers, which is why we have seen this long-running debate in Ukraine about whether they should lower the conscription age so that they could bring in more young men. But it is in a rush because human lives are limited, and that's why for the reasons of personnel supply to the armed forces, but also for reasons of morale, it has to show that it's making progress.
And presumably that's got to be a problem for Putin as well, for Vladimir Putin, given what is happening in the Kursk region right now.
I think one issue to watch very closely is how conscript mothers react to their sons potentially being involved in fighting in the Kursk region. The way the Kremlin has sold this war to the public is you won't be inconvenienced. It's a war that will affect the Ukrainians, not us. And the Russians have managed, or the Russian government has managed to run the economy reasonably successfully despite Western sanctions. But once conscripts start being drawn into the war and potentially killed in large numbers in this war, if that happens in the Kursk region, then the Kremlin will face angry mothers, and angry mothers have made themselves known before, not least after the Kursk disaster, when they were not too shy to openly criticize President Putin.
Do you get any sense that we are any closer to understanding how this war ends?
We are nowhere close to understanding how it ends, and whether it ends militarily or through negotiations, a diplomatic solution. And there are so many opinions about how it should be done, including very different opinions in Russia and Ukraine. And then, of course, we have the global public opinion and Western governments having their own opinion in addition to that.
Elizabeth, thank you for joining us. We greatly appreciate it. Elizabeth Brawl, Senior Fellow at the Atlantic Council. Thank you very much indeed. Coming up, we're going to turn back to trade. Chinese EV makers seeking ways to get around European tariffs. We're going to hear from Xpeng Strategy updates. We're going to hear from its CEO. That conversation next. This is Bloomberg.
goes on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Volkswagen has more strength on globalization, quality, manufacturing, and supply chains. We have more advantage on artificial intelligence, software, and electrical and electronic structure. So I hope we learn from Volkswagen's strength to make up our shortcomings.
The Expect CEO there talking about how his company will learn from its partnership with Volkswagen, and presumably that's why Volkswagen's in this gig as well, because it needs to learn, as we've just been hearing, about what is happening on the software front. This is part, though, of a global narrative that is developing in interesting ways right now when it comes to tariffs. Clearly, the Europeans are partnering with the Chinese, but the Chinese are being excluded from European markets because of what is happening with the tariff front. Canada, the latest country to deliver on that story as well, announcing new tariffs on Chinese-made EVs yesterday. Aluminium and steel products also in the mix as well. Bloomberg's Ollie Crook joins me now around the table to discuss all of this. So the Canadians are the latest.
Yeah.
They are now joining what appears to be a reasonably coordinated strategy amongst Western powers, basically to lockout feels like the wrong way of putting it, to encourage the Chinese manufacturers to build in their own countries, i.e. not to import but to build domestically. How are the Chinese responding to this?
Yeah, I mean, their line has, from the very beginning has been that basically this is in violation of the WTO rules, that this is totally inappropriate, and that basically China's advantage is basically just down to the fact that they make just more competitive cars, they have lower labor costs, they have more sorted out supply chains, and that's exactly what we heard, at the beginning of the show earlier today when they were responding. What's interesting is that, Canada has done basically exact mirroring of the U.S.'s sanctions, which is, 100% on EVs, 25% on steel. It's a concern, particularly after what we've been seeing in the steel market within China, where they have a lot of overcapacity. And obviously they're also ideologically aligned in terms of Canada's view of China. We saw, remember, they detained Huawei's deputy chairman a few years ago on a U.S. arrest warrant, but also it's in their self-interest, right? They build 1.5 million cars in Canada, most of which go over to the United States. So you can't very well be accepting sort of cheap EVs from China and also wanting to sell cars into the U.S. without the trade barrier.
The Chinese build a lot of cars as well.
Yeah.
They're now not going to Europe.
Yeah.
They're now not going to the United States. They won't be going to Canada. Where are they going?
Yeah, so what's really interesting is we do have some of that data out. And actually, when we look at what happened in Canada in the month of July, when you compare it to last year, the sales there were down 28%. So that's really sort of telling you the story of kind of where things are going. But when you look at kind of Chinese car deliveries across the world, in Asia, you go year to date, in terms of what we've seen so far this year, it's up 36%. In Europe, they've fallen 14%. In Latin America, though, up almost 500% in terms of the sort of EV deliveries that have happened year to date versus last year. So while they're being shut out of the European market, there's obviously anticipation of what was going to happen in the United States, so they're not really selling there. But what you're seeing overall net total in the world is, EV sales and deliveries across the planet are up 17%.
What is interesting is that Europe is, the tariffs in Canada and the United States are much higher than we're seeing in Europe. Is that because Europe also exports quite significantly to China and therefore probably runs a risk of retaliatory sanctions the other way. How did Europe feels like it's really caught on this one?
There's a lot of different dimensions here. So of course there's also the green credentials. Europe wanting to be this, carbon neutral. They need to have EVs in order to do that. They don't produce enough of them themselves. They're not at the price that you need to produce it in order to have that. China does help with that. You also have the fact that 36% tariffs is the highest level that you have from Europe. That actually sounds pretty good compared to the U.S. and Canada. And we were talking a little bit earlier about this. The former EU trade minister, Cecilia Malmström, about exactly the dilemma that Europe is in. Have a listen to what she had to say.
The dilemma here is that we need those Chinese cars. We don't have enough EVs at affordable prices, high quality in Europe. So that is why we have not imposed 100%, because we don't want to stop the imports. We just want to slow down so that Europe can catch up. And that is ongoing discussion right now.
So yeah, they kind of need those cheaper EVs, but at the same time, they also, like the Germans, want to continue to sell into that Chinese market. And of course, what's interesting is these tariffs are just a delay, right? Because it's 2 to 3 years before these Chinese companies.
Well, that's the point. Is this about stopping Chinese cars coming into Europe and protecting domestic suppliers, or is it about saying to China, we want your cars, we just need to build them here rather than there?
Yeah, honestly, I think it's a bit of both. If you ask the German car companies, they say, listen, we want free trade. We want none of this stuff. We want to be able to do it, and we want to compete. And actually, part of the interesting side of this for the Germans is that actually this is in some way the pressure that the German car makers need in order to make some of the really tough decisions to companies that are, frankly, compared to a lot of these Chinese companies, very bloated. And there's a lot of difficulty in terms of, the cost of labor and all of these things, a lot of difficult discussions. And of course, another difficult discussion is Hungary. When you look at the price of labor in Germany, which is like 62 euros an hour, versus Hungary, which is 16, I mean, that's another part of this conversation.
I remember talking to Elon Musk years and years ago, and he telling me that one of the reasons he started Tesla was to try and encourage German car makers, German engineers, that electric was the future, and we're still not there yet. It's a big challenge. Ollie, thank you very much indeed. Bloomberg's Ollie Crook talking us through what is happening on the car tariff front. Up next, we're going to talk about what is happening on the political front. France's next Prime Minister. The search for that Prime Minister continues. We're going to have the latest from Paris as President Macron rejects the left's wing choice. We still don't have a name, though. We'll talk about it next. This is Bloomberg.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
trillion industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We have lots of voices that are more rational about economic policy that are speaking now and say we need to keep that pro-business policy. And that's why also we are slashing down this extreme left, because what they are offering is just a nightmare for the market, for the companies, for financing our investments with the spread going up and the interest rate being still high. So we need really to continue the pro-business policy.
Fabrice Lesachet, the Vice President of the French business lobby, MEDEF, speaking exclusively to us a little bit earlier about the importance of pro-business governments in France. Are we going to see that coming to a conclusion? Are the 7 years of the pro-business Macron period now virtually over? Well, we're about to find out. The French President Emmanuel Macron continuing talks to appoint a Prime Minister. That carries on today. He has ruled out a leftist candidate, Lucie Castet. That is now off the table. But who could be the name that fills the frame? Let's try and find out. Let's go to Paris. Caroline Conan standing by for us. So why the rejection of the left candidate? Talk us through the importance of that choice and where it leaves us.
You know, at the MEDEF conference also yesterday afternoon, we heard from the President of the National Assembly from Macron's party. She was also saying something similar to Fabrice Lesachet, that it takes 10 years to build a pro-business agenda, to build a pro-business policy, to attract all these new investments to France, but it only takes a few days to undo it. This is obviously one of the reasons why Emmanuel Macron does not want to nominate a left-wing prime minister, even though the New Popular Front actually came first in those snap elections with more than 180 seats. He knows that the New Popular Front does not have the majority and would potentially face a vote of no confidence. So today, Emmanuel Macron has decided to open a new cycle of negotiations, but we don't know at all who is actually attending this new cycle. We know who is not coming. No one from the left wing is coming. Even the socialist head, Olivier Faure, said this morning that he does not want to be complacent with this parody of democracy. The far left has called for destitution of the president, and the communists have called for protests in front of regional public buildings.
Caroline Conan in Paris, thank you very much indeed. Cazeneuve seems to be the name still in the frame. We'll see whether or not he ends up being the candidate that we ultimately end up going with in France. That wraps things up. US futures pointing to a mixed, flattish start to trading a little bit later on, but you do not want to miss Bloomberg Technology half-hour special tomorrow. We have an exclusive interview with this man. The NVIDIA CEO, Jensen Huang, is going to be talking to Ed Ludler. I am really excited about this. This is going to be a fantastic conversation. Up next today, it is The Brief, Manus Cranny in New York. This is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf. There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670 odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, we're owning this space.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Stocks stabilize after a tech-led pullback. Investors count down to the macro event of the week, NVIDIA. A message from China, from e-commerce to commodities. The warning signs pile up. And U.S. National Security Advisor Jake Sullivan touches down in Beijing for a 3-day visit. Some people say when the conduits of communication are open, that's the critical point. This market is building up the biggest macro event, which is NVIDIA. Get ready potentially for a 9% swing on the day. That's nearly $300 billion. We pull it back. We were down 1% yesterday on the NASDAQ. We pull it back up by its bootstraps this morning. The S&P 500 on the equal weight made a new all-time high yesterday. Bank of America suggests that that new all-time high on the equal weight is a pivot for broadening. I want to work at the Goldman Sachs buyback desk. That's actually my version of Nirvana. The phones are just ringing off the hook. They have been inundated with buyback calls. They also say that you're getting a $17 billion of unemotional, I love that, unemotional demand between robots and corporates. So that's going to build to the pillar there in the equity market. The bond market, again, the narrative from Mary Daly, along with a number of others, is building up that the time has come. Dial back is the narrative from Barkin. It's going to be hard to derail the September cut, except the IB chat that I've literally just had with somebody in the Middle East who's a bond broker. He's saying, actually, we're all focused on NVIDIA. It's the most boring start to the week that we've ever had. But if NVIDIA disappoints in any way, it will reignite the fury in the rate market for a 50 basis point cut. Go figure. Oil is down by 0.5%. Goldman Sachs, Morgan Stanley, both really taking the side to their estimates. Goldman's cuts Brent to $77. They say the surplus that's going to come back from the OPEC Plus add back into the market is going to be a penalty for those other non-OPEC producers, strategically disciplining the market with OPEC supply. So that is your risk-ometer. The key event will be NVIDIA. Fed speak. San Francisco Fed President Mary Daly spoke to Bloomberg about whether it's appropriate to, you got it, time to cut rates.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
The time is upon us. The time is now. Dan Morris is the Chief Market Strategist at BNP Paribas. And you add into Barkin, it's time to dial down the rates. Dan, good to see you this morning. How high or how low is the bar to a 50 basis point cut in September?
Well, I think always the market doesn't want to be surprised, and there's going to be an assumption that if they actually do cut 50 without some economic data between now and the actual meeting to justify it, there'd be the worry that, oh, does the Fed know something that we don't know? Are there further signs of weakness that we haven't come across yet? So that does seem to be a bit more in line with a swifter slowdown to growth than we currently see. And I don't think the Fed is going to want to surprise the market in that way. So we think the bar, to answer your question, is relatively high, and the Fed will probably be happy with 25 basis points.
And we're gonna count down to the jobless claims. Never have weekly jobless claims been so excited and so focused on. But before that, we get NVIDIA. I said at the start that NVIDIA could be the redefining of the rates risk. We're getting ready for a 9% swing around on NVIDIA. Correlation is something like at 78%, according to Bank of America. How important is the NVIDIA results for the narrative of cuts and momentum?
I would say not terribly. I would hope that the Fed is not making its decision on the outlook for policy rates based on the results for one company. We think broadly the outlook for tech, for NASDAQ is positive. The outlook for the economy is good. Certainly anyone who's very heavily exposed to NVIDIA is going to care a lot. But for us, it really wouldn't fundamentally change what we anticipate through the end of the year, which is for further gains, and particularly for NASDAQ.
Okay, so you're not that attached to it. It's going to be one of those swing events in the market. But one thing for sure is that the 60-40 portfolio has performed. It really has performed. It's at a record over the past couple of days. And I just wondered to what extent you look at that kind of performance in the traditional model, and you sort of say, okay, so bonds are now doing what they're supposed to do in this construct. When you look at 60-40, how does that bear out for you?
Well, in fact, we're actually looking for other assets, if you will, to provide the diversification that typically you look for in the 60-40 portfolio. If we think about the prospect, particularly for U.S. Treasury yields in the future, inflation risk in the event of a Trump victory, regardless of who wins, we should and are concerned about debt levels and so on in the U.S. That would argue for higher yields, and perhaps, therefore, you don't get that diversification benefit. Therefore, we've been adding to our allocation to gold as a way to hedge against those inflation risks, those debt level risks, the geopolitical risks, and that seems to be the better way to look for a hedge for a multi-asset portfolio.
And just how much have you been adding? I mean, obviously we made a new record. We touched through 2,500, etc. So just how much more gold are you adding?
Well, in our multi-asset portfolio, it's the biggest overweight that we have. Always evaluating how that looks given the performance that we've had, but that's our position today.
So the dollar has collapsed, over the past month, 3 months. You've broken through the 200-day moving average. It's one of the biggest drops below the 200-day moving average in more than a year. Now, yesterday's conversations, I had Bank of America saying, look, this dollar drop, this crumbling in the dollar is just overdone. When you see that kind of collapse in the greenback, what does that flag to you, and what does it deliver for you?
Well, we don't have a specific dollar allocation in the portfolio, but actually it's implicitly reflected in the allocation to gold, because typically a weakening dollar is positive for gold, and conversely a strengthening dollar negative. Now, that hasn't been the case for much of this year because you had all these other factors, particularly the hedging properties of gold, that have overweighed the drag that you would anticipate from the strong dollar. Now that you've got the dollar weakening, it's just added another impetus to the support for gold prices. So implicitly, that seems to us the best way to take advantage of the weakness in the dollar.
So if NVIDIA is not going to bear terribly on your thinking in terms of your allocation to tech, how much of that growth allocation is going to be determined whether you get 3 or 4 cuts from this Fed? Well, it could be 3 cuts and 100 basis points, I grant you. But to what extent is the allocation to growth predicated on a cutting cycle?
Well, certainly that's implicit in the price action that we've already seen. I think always when you know you're on a slowing path for U.S. growth, because implicitly the story this whole year needs to be that U.S. growth slows, otherwise you're not going to get inflation back to target. That's all well and good. That's probably what the data supported. But there's always that risk that that slowdown goes too far and you do tip into a recession. Now, at this point, we see that risk as relatively low. Of course, it's never zero. But unfortunately, we are still quite data dependent, and we're going to be watching what we get for non-farm payrolls, what we see on the unemployment claims to see if that deceleration is accelerating. That certainly would change the outlook and our allocation. But for the most part, for now, we do think it is going to be a slowdown to a soft landing, which would leaves us overweight to NASDAQ in the U.S.
So if gold is your hedge, a soft landing, no recession is your base case, what's the biggest risk that you're taking?
I think it's, in terms of the biggest risk, I think it would be that you do see that surprise slowdown in growth. I mean, if we appreciate that really everything since the pandemic has been unpredictable because it has been an experience that no model could take into account since it had never happened before. So I think the confidence level for any honest economist or strategist has got to be relatively low, trying to anticipate what's going to happen. Let's not forget, at the beginning of this year, we had those big inflation surprises, and we were talking about renewed overheating. Now we're back to trend level inflation. Hopefully that persists, but we appreciate really any month that could change again.
That is the joy of pivots. Dan, thank you very much. Dan Morris of BNP Paribas Asset Management with his calls. He's brave. He's not worried about the swing factor from NVIDIA. Well, we are on Bloomberg because we've got an exclusive conversation with the NVIDIA CEO, Jensen Huang. That is special live coverage tomorrow, 6:30 p.m., right here on Bloomberg Eastern Time. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. More changes in the Apple C-suite. It's the longtime CFO, Luca Mastri, will step down, and that's at the end of the year. He will be succeeded by a top deputy. Kevin Parekh. Apple's management team is likely to see some more changes in the foreseeable future, with many of its executives at around 60 years of age. Skydance is set to become the new owner of Paramount after Edgar Bronfman dropped out of the bidding war. This ends one of the industry's most dramatic acquisition contests. The deal is expected to be completed in the first half of 2025. And it's no longer a definitely maybe. Oasis has confirmed that they will reunite for a tour starting next July in Cardiff. Now, that's in Wales. It's the Britpop band, and they split 15 years ago. The brothers basically could barely be in the same room as one another. It's not going to be on TV. You're going to actually have to buy tickets to go. And it's a real sort of moment of angst for all the fans out there. Noel Gallagher in 2009, when he walked out of the band, he said he simply couldn't stand working with his brother Liam another day longer. The guns have fallen silent, the stars have been aligned, and the great wait is over. Come and see us. We're not on the telly. I want to have a quick check on the yuan. This is one of the most read stories on Bloomberg Terminal this morning. This is the drop in the dollar, the rise in the yuan. And what we have is a real story about an avalanche. And this is the structural investments by Chinese companies in the U.S., by Japanese companies in the U.S., the pile of repatriation. You could get $1 trillion of FX divestment and an avalanche back into the yuan. This is according to Stephen Jen. And that would move the yen higher by nearly 10%, something that he says the authorities will probably allow a 5 to 10% appreciation. Get ready for the avalanche back into the yuan and maybe even a trickle back into the yen from structural dollar investments. Most read story on Bloomberg. Coming up, the National Security Advisor Jake Sullivan meets China's Wang Yi on his first trip to Beijing. More on the story. That's next. And later this hour, 25 or 50, we'll discuss the Fed's rate cut path with Lawrence Seidel-Bacher of IT or Economics. Context Matters on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Manish Cranny in New York. Good morning to you. President Biden's top security aide, Jake Sullivan, met with the Chinese Foreign Minister Wang Yi. This was in the last hour. It's the first visit to China by a U.S. National Security Advisor since 2016. It's been a while. Jill DeCease joins me now. So Sullivan has touched down. Look, a lot has been made out of this. It's been 8 years since he's been there. It's not as if he hasn't met with his counterpart. There's been a series of meetings building up to this onshore meeting, so to speak. Jill, good morning.
Morning. Yeah, Manus. I mean, look, there's a lot that it seems is going to be on the agenda here. So, you know, you obviously just saw some of that tape there of Sullivan meeting there with Wang Yi. He's in for about 3 days or so of meetings. He might meet with Xi Jinping, you know, to be confirmed. We'll have to see ultimately where we go ahead with that. But Sullivan's really here to kind of, you know, reiterate some of the U.S.'s positions on several different issues here. One, obviously, you know, the U.S. is concerned about China's continued backing of Russian forces fighting in Ukraine. That's probably going to come up. I think the Taiwan issue is going to come up. Obviously, Taiwan considers itself democratically ruled island. The U.S. You know, has some relationships there that it's, you know, wants to protect, whereas China obviously claims Taiwan as part of its own, you know, sort of its own, you know, sovereignty kind of a thing. And then you also are probably looking at a lot of questions over, you know, a lot of the U.S.'s pushes on, you know, tariffs and other levies on Chinese tech, advanced manufacturing sector, how that's playing into the Chinese economy picture. We just saw, you know, Canada, you know, major U.S. ally there, just implement new tariffs on EVs and stuff like that. So there's a lot on the agenda here, but I do want to point out here, Manus, that this is kind of interesting timing for this trip because, as you know, we've seen, I mean, you know, obviously Jake Sullivan is part of the Biden administration, of which, you know, Vice President Kamala Harris now running at the top of the Democratic ticket is, but we've actually reported fairly recently that he's not looking to make this meeting, you know, about Kamala Harris or anything like that. But it does, I do want to point out, come at this kind of strange, you know, weird election timing, which I think is potentially could play into this trip here.
Look, everything that happens on the world stage has got a backwash into the political voting that we're going to see in this country. I mean, if you think about the Trump narrative, it has been strong on China, 60% tariffs. The Biden administration continued many of those tariffs. So to a certain extent, one's got to ask oneself whether this is laying the groundwork for a much bigger piece of theater, which would be as Biden exits the U.S. White House. Maybe it sets the stage for that meeting between him and Xi.
Yeah, I mean, that's certainly possible here, Manus. So look, you know, they'll have an opportunity to do that a little bit later this autumn at the APEC summit. So that would really be kind of a swan song for, you know, Biden leaving the administration, no matter who really comes in there. So maybe we're seeing a little bit of work paving the groundway there. But again, I think that with so much focus on the U.S. election and uncertainty about whether it's going to be Kamala Harris or whether it's going to be Donald Trump returning to the White House, that does kind of complicate the picture here. But all that being said, Manus, I mean, look, we've seen over the last 4 years, the Biden administration has gone pretty hard on China on various issues. We've just talked about advanced tech, talked about semiconductors, all these different things where they, preserved some of these Trump tariffs. So whoever's coming into the administration in January, you are still probably looking at a fairly strong perspective on China. It's just a matter of in which areas and what that ultimately looks like.
Yeah, and certainly hard signs along the way before we get any kind of a change in those. Jill, thank you very much. Great content. We'll track Sullivan's journey through China over the next couple of days. Jill DeCease. Coming up in the show, I look at what else is making headlines around the world for you, from the newspapers to Bloomberg.com, right here on Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Bloomberg Brief. I'm Manish Krenny in New York. Good morning to you. Front pages, this is what we've got making headlines around the world. First up, Financial Times leads with Zuckerberg. Mark Zuckerberg says that the White House pressured Meta over COVID content. It was a letter to the House Judiciary Committee. Zuckerberg says he believes the pressure was wrong and regrets they were not more outspoken about it. Next up, the Washington Post, more than 200 Republicans who worked for the former President Bush and Senators John McCain and Mitt Romney are endorsing the Democratic candidate Kamala Harris. In a letter, the group said a second Trump presidency will hurt real, everyday people. And Bloomberg leads with the company that owns Temu, sending a warning sign on the Chinese economy. Shares in PDD plunged as much as 30% after a disappointing outlook. That is an understatement, to say the least. For more on the PDD results and what it says about the challenges facing the Chinese economy, let's get to Katya Dmitrieva. She joins us now from Hong Kong. Katya, thank you so much for joining us. If you just look at the language around this, revenue growth is not sustainable and a downward trend in profitability is inevitable. Is that because of competition or because of a demand that's cratering? Is it a combo, a toxic combo, or what is the alpha?
Yeah, it's a good question because it's a little bit of both, unfortunately, for the company. You have revenue growth that's slowing, but the stock didn't necessarily react just to that, to this revenue missing estimates. It was more so the forward guidance. You know, there's this really negative outlook on the economy. And for companies like this, you know, you have to think about it, right? When an economy slows, you tend to see an increase and better performance from these kinds of stocks that benefit from that kind of situation, with consumers who are going down, who are buying cheaper goods. And Temu was one of them. You know, it was a darling for a very long time. Made the CEO very rich. And yet demand for that is slowing because not just the economy is kind of slowing in China, but also demand for a lot of these goods and consumer goods in particular, which that's a big question, is whether Beijing can actually stimulate that. And so hearing a company discussing that forward guidance in such a moody, kind of gloomy tone, you know, the executives actually mentioned it about 8 times, this negative forward guidance, during their conference call. It's a kind of a negative, definitely a negative sentiment for the economy and for this company.
Yeah, it certainly is, and it also a warning on dividends and buybacks as well. Now is not the time. Look, it's not just PDD that we've heard from okay, we've got the e-commerce space, but also warning shots from BHP. They're also seeing a siren in the appetite in the iron ore market in the country. The CEO, Mike Henry, caught up with Bloomberg a little bit earlier on the economic recovery.
We believe that the fundamentals remain intact for China to continue its growth beyond kind of its middle income status currently. They're obviously focusing on high quality growth, and we expect that as they do continue to grow the economy, it's going to mean plateauing of steel over time, a constrained iron ore market, but increasing demand for some of the other commodities.
Look, I think Henry just really lays bare what we already kind of know, which is that the housing and the wealth that was built in housing is under pressure. But there was nuggets in this around the miners' earnings as well in copper. But what did it tell us about the real economy in China, briefly?
Yeah, it's the other side of the coin, right? You have a slowing consumer demand, and you also have less demand for things like steel in the property sector. You think of all the condos that have been built or left unfinished. A big part of that is steel. And so if you have this glut of supply, it's going elsewhere. They're not able to get it domestically.
No, certainly pressure coming to bear. Katya, thank you so much for being with us. Wrapping up the stories in China. Coming up, we'll catch up with Lauren Seidel-Bacher of IT or Economics on the very latest assessment of FedSpeak and the roadmap to PCE on Friday.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From our global headquarters in New York. Welcome to Bloomberg Brief. I'm Menace Crenny. Let's set your agenda. Stocks stabilize after a tech-led pullback. Investors count down to the macro event of the week, NVIDIA. A message from China, from e-commerce to commodities, the warning signs pile higher. The U.S. National Security Advisor Jake Sullivan touches down in Beijing for a 3-day visit, keeping the channels of communication open there. Likewise with the market, NVIDIA. Jensen Huang will join us tomorrow live on Bloomberg at 6 p.m. in the afternoon. And this is in part the obsession by the market. It is the macro event. We're getting ready for a 9% swing in either direction on NVIDIA, according to the options market. Stocks gave back about 1% yesterday on the NASDAQ, but it almost feels like this market of risk is on a runway, at the beginning of a runway of an airport, and the throttle is fully revved. So whatever happens with NVIDIA could turn the narrative again about a 50 basis point cut in the rates market. It won't define what the Fed is going to do, but it's certainly going to be an element. It's the only thing the rates traders are actually looking at, according to my sources. The equal weight on the S&P 500 made a new all-time high yesterday, and Bank of America say, look, in part, this adds the broadening and the rotation narrative that they see. I like what Goldman Sachs are saying about stocks. $17 billion of unemotional demand between robots and corporates. I wish we could have unemotional demand every day. NVIDIA is up 0.5%. Get ready for the unemotional flow of money into equities. Bonds are 394 is where we are. Mary Daly says it's time to adjust policy. So again, the call, the narrative, the framing of the narrative, the time has come from Powell. The time to adjust policy is upon us. It's going to be hard to derail a cut in September. Brent is down and it's cascading lower. We'll talk more about this in just a moment. Goldman Sachs, Morgan Stanley cutting their forecast. Goldman's are at $77 for Brent. The surplus is going to mean a harder market to deliver. But this is about OPEC strategically disciplining non-OPEC supply. More on that in a moment with our editor, Will Kennedy, on the oil market. I mentioned the Fed rhetoric. Well, Mary Daly, the San Francisco Fed president, she echoed Chair Powell that the time has come to cut interest rates. Markets now debate how far the officials will go with the easing cycle. Let's take a listen to what Daly had to say.
The neutral rate of interest is of course, constantly debated, and people are thinking about that now. For my own self, I think of it as if we came in to the pandemic at a 0.5 real neutral rate, I can see it being as high as 1 now.
So warning there from Mary Daly on where the real rates lie. Lauren Seidel-Baker is with me, economist at ITOR. Lauren, good morning to you. Every day we start with 25.50, 25.50. You would say it's a more important thing to stand back and say, what are we going to get in this cycle? And you would say we should brace for disappointment in this cycle. So how bad can it be relative to the optimism of the market? Good morning.
Good morning. Yes, and I am
an economist, so I have to be a little bit pessimistic here at least, but we do expect that 25 basis points is the most likely outcome for September. 50 basis points would just be such a huge move out of the gate. I think that would really be the Fed admitting that they should have cut sooner. That said, they're not usually one to knee-jerk react to any one data point. I know we've had just a month or two of soft labor market news. The Fed isn't really looking to catch back up. So what I see as the most likely case is 25 basis points in September. And in his comments at Jackson Hole, Powell did allude to rate cuts in the plural, the path, so-called, of interest rates going forward. So I don't think this will be the only cut. However, I think 100 basis points is really the upper end of cuts that we should expect. I certainly do not expect rates to go back down as low as they were immediately pre-pandemic. This is just a different labor market, a different inflationary environment. And so we will have to adjust from this ultra low interest rate environment that we've all gotten so used to.
Look, I'm interested in your thesis, which is inflation will reassert itself. Now, part of the argument for a number of people is cut too hard, cut too fast, and you could reignite the trajectory of inflation. Why do you think inflation will not resurrect itself, turn higher in 2025? What's the impetus for that thesis?
Sure. The impetus is not only the Fed cutting rates. So there will be some stimulative effect from that. That will encourage higher inflation. But we have a number of other leading indicators that are really already showing the signs of the next inflationary cycle to come. For example, gross Treasury issuance today is actually higher than it was at the peak of that stimulus era, pandemic era spending. And so there's a lot going on. I know we talk about the money supply having contracted, but again, that's very much a leading indicator. We're at such a higher level right now that magnitude is going to be inflationary. So expecting a little bit of softness this year. We've seen that in things like the manufacturing pullback, a little bit of cooling, maybe I'll call it flattening in the industrial economy. But 2025, we already see the green shoots. We see the resurgence of demand. That demand pull on prices will manifest itself. So whether the Fed cuts hard and fast or whether they cut a little bit slower, I do believe the inflation cards are stacked against them. They got so burned with high inflation last rate raising cycle, they really do want to keep one eye on the inflation leg of their dual mandate.
Which then takes us to the discussion. By the way, we were just showing the 5-year break-evens there, which many people have sort of said, actually, now's your opportunity from a market perspective, which I know you're not, to load up on a hedge and perhaps buy those on the take-up. But it takes us to the much bigger debate, which is where, and this is way too intellectual for me, where's the or star? As Larry Summers says, 3% of a neutral rate is just too low. I presume from what you've just said, you may well concur with said Larry Summers, and you're going for a slightly higher or star or neutral rate.
I think this is a moving target. What was true pre-pandemic is certainly not true now. We heard Powell really address the historical nature of this experience, the fact that we all thought inflation would be a little bit more transitory this cycle. I'm not sure it's so much the fundamentals as what non-economic events are hitting us. So things like the pandemic and the echo effects that we are still feeling from the pandemic. Certainly those supply chain issues were unprecedented. So to see geopolitical tensions heating back up, I think that is raising a lot of hackles with the potential resurgence of supply chain concerns. So it's much more of a tactical target at this point. And again, the Fed is aware of that. Their recent focus is shifting from that inflation side of their mandate to the labor side of the mandate. The data fully supports that. So that's why we will see this rate cutting cycle begin. But again, a moving target, it's going to be for the historians to determine what we got right and what we got wrong.
How, if at all, does politics come to bear? You talk about non-economic events. Well, of course, politics and economics are inextricably linked, and one cannot disaggregate them. If you look at some of the narrative from the Trump campaign, which is tariffs, which is around immigration, deportation, etc., and to a certain extent, the the Harris-Walz ticket. What we know, and we know very little so far, is some people would say it is a pro-inflationary narrative as well. But if we take the Republican side, first of all, that's perhaps a little bit spookier for the bond market relative to the Democrats at the moment in the assessment, and we await more detail, of course, on the Democratic ticket.
Absolutely. From a big picture point of view, the good news that I have to give is that there is no statistically significant, consistent relationship between red or blue in the White House and the economy doing better or worse. Now, I mean that from a high level view, so things like GDP, the industrial sector, manufacturing activity. Obviously, things like tariffs, that will skew asset prices in that targeted asset. But from the Trump side of things, I mean, we do see immigration as a potential mitigating factor to this very tight labor market. Even as we see a little bit of directional loosening today, businesses are struggling to hire. We do not have one unemployed worker for each available job opening. We're still at a dearth of workers. That's going to be a long-term trend just due to our demographics in this country. So potentially seeing some implications for immigration there just in terms of labor availability. Other items like tariffs, it's interesting, both administrations, the recent Trump tariffs as well, Biden tariffs, as well as the prior Trump administration have been shown to use tariffs as a policy lever. Tariffs at the end of the day are, of course, inflationary, so that's another kind of tick in the column for inflation, but something that we've seen from both parties.
When you talk about, and you've referenced the higher inflation at the start of this conversation, as we come to the close of the conversation, again, you reaffirm that higher inflation. So what kind of propulsion are you talking about? Are you talking about an incremental rise in inflation? You're certainly not talking about a resurrection of inflation back to the very high single digits that we saw at the zenith of post-COVID.
Absolutely not.
Okay.
We saw the consumer price index peak around 9% this most recent cycle. I do not expect to get back to 9%, but I also expect the CPI to kind of touch 2%, not go much below it before it starts rising again into, let's say, the mid-single digits, lower to mid-single digits, but above that 2% target. So inflation will feel different, but again, this is a cumulative effect on our consumer. We haven't lost that 9% gain. We are just seeing prices go up to a lesser degree. So cumulative effects still being felt, still giving a little pressure to the U.S. consumer.
Finally, an economist that admits that we still have to pay the extra 9%. Nobody's cutting the prices there. Let's just square off one thing very, very quickly. So it's going to be a lower and shallower cutting cycle. That's fine. I take that on board. What's the risk of a reversion and having to hike next year?
I think that risk is very real. I do expect that
20%, 30%?
Sorry?
I mean, you say very real. Just quantify that for me. A very real risk that they would have to U-turn next year.
By the end of the year, I think greater than 50% risk. Again, we will see a bit of a flat bottom this cycle, but by late 2025, I would not at all be surprised if we see rates hiking again.
Ah, there you go. Ode to joy at the end of the conversation. Lauren, thank you very much. Tin hats on for the back end of 2025. Lauren, thank you very much for being with me. Lauren Seidel-Baker of IT or Economics. Coming up, the U.S. National Security Council. Security Council Jake Sullivan kicks off his first official trip to Beijing. More on this story next on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
National Security Advisor Jake Sullivan meets with his Chinese Foreign Minister Wang Yi in the first visit to the country by the U.S. National Security Advisor since 2016. Jill DeCease is with us. So it's the first time in 8 years that this kind of level of advisor has been in China. How significant is that in the messaging that there's some kind of a meeting, rapprochement between the U.S. and China, even though they have many issues that really clearly divide them, from tariffs to trade to Taiwan?
Well, certainly, Manus, it's important. I mean, look, as you said, we've certainly seen ways in which the U.S.-China relationship has really struggled over the years, deteriorated in many ways. Obviously, Trump, under the Trump administration, launched a trade war against China, but a lot of those tensions have continued under the Biden administration. We've seen a lot of, increased tariffs, other punitive measures, specifically targeting advanced technology in China, manufacturing, semiconductor industries, that kind of thing. This meeting is also coming just as Canada, major U.S. ally, announced some additional tariffs on Chinese EVs, some of those other products. So yes, there's certainly a lot of tensions that remain within relationships between both China and the West, and obviously with the United States, all kind of culminating in this very significant meeting. Now, what does all that mean, Manus? Does it pave the way for some additional meetings between high-level U.S. officials and Chinese ones? We'll have to see. I think, we're certainly looking to see whether that actually means maybe we get a Biden-Xi meeting later this year at the APEC summit or elsewhere. The big complicating factor, of course, in all of that, Manus, is that we've got a major U.S. election this year, and Biden is no longer at the top of the ticket for the Democrats. That's, of course, is Vice President Kamala Harris. We've reported recently that this Jake Sullivan meeting, they want to make clear that this isn't sort of paving the way for any kind of, Kamala Harris. He's not speaking for an incoming Kamala Harris administration should she actually win that vote. But at the same time, we've talked to several analysts who have wondered, is this kind of a way to sort of Trump-proof things with China in the event that Trump actually succeeds in November? We'll have to see what ultimately happens there, Manus.
In terms of what would be seen as a geopolitical win, both of them are having this meeting. Both of them have a lot on the line. We've got lots of messages coming through about slowdown in China. Trump taking to the White House could potentially mean 60% tariffs for China. What is a political win for both sides? Briefly, Jim.
Well, look, ultimately, Manus, I think what China wants to make sure is that there's not any kind of, more aggravated measures, as you just mentioned. There's a lot of concerns about China's economy right now. We did get some pretty good industrial data there, but the Chinese consumer continues to struggle, and anything involving manufacturing, I think, would ultimately be there. So I think that if they can come out of this, maybe paving the way for an additional meeting, maybe that's ultimately what they see as a win here.
Okay, Jill, thank you very much. I know it's wrong to go to the bottom line on what is a win, but they both got to spin it one way or the other with the papers and the messaging afterwards. Jill DeCease on Jake Sullivan touching down in China. 3 days. We'll track it for you right here on Bloomberg. I want to stay with the China theme. You've got shares in Temu owner PDD bouncing back after a double-digit decline. The e-commerce firm's latest earnings flash a warning sign on the Chinese economy. Temu became the market darling of its low-price goods. For more on the results, PDD's results, let's get to Katya Dmitrieva. Katya, I mean, we've touched on this a little bit earlier. This was going head-to-head with TikTok, head-to-head with the other major e-commerce platforms in China. I want to get a sense from you, the numbers and whether it reflects just growing competition or a dissipation in the middle-class pocketbook.
Yeah, it's definitely both. I think one of the new things here, at least for the company and why the stock seemed to react so much, is just we're seeing the numbers, how the competition is playing out. So yes, they've had competition for a long time from other companies locally, from other tech darlings. But in this case, you're actually seeing it come through in the second quarter results where revenue missed and we had that big record drop in the stock. What was also interesting is just how downbeat they were on the China consumer. I think we've known for some time that Chinese consumption is slowing, but usually, something I mentioned earlier is when you have a slowing economy, you actually have companies that do really well. And in the US, that's Dollar Tree, it's Walmart. They cater to people, to consumers and households who are sort of moving down the value chain as they get, as their wages move down or flatline, as they could boost jobs, as the economy slows. And in this case, it's quite a worrying sign that you have a company that caters to this demographic that's also seeing some slowness. So it's kind of a sign that not only are consumers moving down in the sort of value chain, but they're also potentially just buying less. And there's other companies recently throughout China that have kind of voiced similar messages about the economy that things are not looking that great. And it's always good to supplement these sort of company guidance and company information with what we're getting from the government. You know, GDP data is very helpful. We have retail sales numbers, but as you know, they're not as detailed as we get in other countries, in other large economies in particular. So these kinds of company anecdotes and color, they're really helpful. And in this case, they're not very positive.
No, certainly not. I mean, that stock PDD is taking a bath this morning. Katya, thank you very much for being with me. Katya Dmitrieva. Elsewhere in commodity land, oil snaps 3 days of gains amid supply woes and a shaky demand outlook. Goldman's now see Brent averaging $80 a barrel through 2025. Will Kennedy is with me on this. I love the blog this morning. Will, good to see you. Oil is losing friends on Wall Street as OPEC plus supply hike, risk. I mean, to lose friends and alienate people. I know that this is a great story, but this is about supply coming back from OPEC plus, and that's the core of the worry here in the analyst notes.
That's a big part of it, I think, Manus. The background here is that we've had a summer where oil supply has been tight. The world has had a pretty good balance, or perhaps even a slight undersupply in oil, and people are looking into the rest of this year, and especially next year. And when you combine OPEC's plan to bring production back to the market with doubts about the economy, especially in China, and robust growth in other parts of the world, like the United States and South America, you get balances that are looking a lot weaker for next year. So that's got Wall Street thinking about how things are looking, and a certain pervasive gloom about the outlook into 2025, as you mentioned.
When I look at some of the lines in Goldman's notes, strategically disciplining non-OPEC supply. Now, I think that's interesting because this goes to the heart of the issue for OPEC, which is the ability to move, but they don't want to have an all-out war. I mean, that's what they want to avoid. So that's what they've got to try and balance. If the interest is strategically disciplining non-OPEC supply here in the United States of America, other oil producers will. How finely balanced is that between the all-out price war that we saw unleashed sometimes by OPEC with this balance, this balancing act that Goldman suggests they want to try and achieve?
This has been the strategic dilemma for OPEC for more than a decade now, since we really saw the development of fracking and the boom in oil from the US, is that when they cut production to keep prices robust and to keep the market balanced, it encourages barrels from non-OPEC suppliers. So they're always having to make this balance, and I think they're entering a period where that balance may become trickier still, and it perhaps may be in the interests of OPEC in the medium term to tolerate slightly lower prices to avoid even faster non-OPEC production. But there are many risks. I don't think we should see this as two one-way manners. We've seen in recent days how geopolitical risks have come to the fore. The tensions between Iran and Israel remain critical to the oil market and in traders' thoughts. And then again in Libya, where we've seen a threat to close down the majority of oil production and exports from one of OPEC's North African producers, 1 million barrels of oil at stake a day. It shows that these geopolitical risks do remain, and this is far from a one-way story.
It certainly is, and the market is picking up pace, now down 1% on WTI. That is definitely what you call losing friends on Wall Street. Well, thank you very much, Will Kennedy, our managing editor for commodities. Coming up, we'll get you set up for your trading day ahead. Context matters every day from Bloomberg Brief in New York.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington. It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
How does the rest of your day look apart from tracking the NVIDIA stock price? The Conference Board Consumer Confidence will hit the tape at 10 a.m. Eastern. After the bell, you get retail earnings from Nordstrom. How tough is it for them on the streets? It's been a tough time for retailers. Tomorrow, SpaceX's Polaris Dawn spacecraft will make history and conduct the first commercial spacewalk, we anticipate. Some stock movers, Paramount. Producer David Ellison, Skydance Media, is set to buy Paramount finally after Seagram Edgar Brofman withdraws his bid. And there is only one event, the numbers and the conversation. For the context on the numbers, the CEO of NVIDIA, Jensen Huang, joins Bloomberg at 6:30 tomorrow.
terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region, simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
My baseline is that the Fed cuts by 25 basis points.
I think they'll go fairly slowly and feel their way along.
I'm kind of discounting the probability of 50 basis point cuts at this point. It's going to take a little bit more weakness or materially more to push the Fed to 50.
They're probably going to start in September with 25, but I really hope they ramp up the pace to 50s.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. Bloomberg Surveillance starts right now. It's a quiet start to the last week of August. A quiet start coming into Tuesday. Equity futures on the S&P 500 looking a little something like this. Futures just about positive by 0.1%. Coming off the back of a little bit of weakness in big tech. The Nasdaq 100 yesterday down by more than 1 full percentage point. Look at what was happening elsewhere. Equal weight, flat, small caps, unchanged. The relative outperformance, Lisa, there to stay in yesterday's session.
I spent a long time last night thinking about, are higher rates good or bad for big tech? And when you have lower rates, how much does that give a boost to big tech versus the rest of the complex? This was a complicated question, say 2-3 years ago, when big tech benefited disproportionately from low rates because that boosted valuations. Then suddenly it was rates didn't matter because they had had so much cash they didn't have to borrow. Now where are we in that? How long can this outperformance of everyone but tech continue?
I'll share the view of Bank of America. Powell sealed the deal for a September rate cut at Jackson Hole, leaving intact our thesis for continued broadening and rotation. And they're not alone. We'll catch up with a few guests this morning who are on the same page, looking for the same rotation to continue.
As long as the economy continues to chug along with those rate cuts, and I think that is ultimately the tension that we felt yesterday from a lot of guests on the show who came on and said, look, right now we're pricing in the level of cuts that would be commensurate with some sort of downturn. There is a tension there with the amount of optimism baked into risk assets. You got to choose pick your poison. Do you want rates to get cut that much, more than 200 basis points of rate cuts by the end of this year? Or do you want an economy that's intact? You're not going to get both.
It's a really, really fine line at the moment. The week ahead, the calendar. Let's take a revisit of things and take a look at it. We've got the big one for earnings tomorrow, NVIDIA. You've got the big one for the data, arguably Thursday morning. It's jobless claims. Today, we've got $69 billion of 2-year notes coming to market. Lisa, that was just for you.
Thank you.
And consumer confidence a little bit later this morning. What takes your fancy?
Well, I think that consumer confidence is going to be important. Of course, I'm watching the bond auctions, but the truth is, and don't tell anyone, no one's watching, but I think they're probably not going to be all that interesting this week. You've got 2-year, you've got 5-year, you've got 7-year, but ultimately you've got so much demand for U.S. Treasuries. I can't imagine it's going to be overly messy. Watch them now be really messy see in the most interesting parts of this week. But to me, really, it's about positioning ahead of NVIDIA most of all, because right now, ahead of Wednesday, it really is how much is this really the necessary overweight for fund managers at a time when you kind of are damned if you do and damned if you don't. It's one of the biggest weightings in the index by far.
That's where the performance has been for quite a while. This was the snoozy 24 hours we were looking for all summer. And then it never came. We just want more of this, don't we? Into the Labor Day weekend. We'll see if we get it. Equity futures on the S&P then just about positive by 1/10%. If you are just joining us, welcome to the program. Yields are higher by a couple of basis points, 383.49. The euro showing just a touch of strength, 111.69 on euro dollar. Coming up this hour, we'll catch up with Chris Marangi of Gabelli Funds on why he sees continued rotation away from mega cap tech. Ed Mills of Raymond James as Trump and Harris once again debate the next debate. And Kit Jukes of SocGen on what a labor market slowdown means for the US dollar. We begin with our top story. Stocks taking a breather ahead of NVIDIA earnings tomorrow. Chris Marangi of Gabelli Funds writing the following. We expect continued rotation from mega cap tech to small caps based on relative valuations and the prospect of lower rates. Chris joins us for more. Chris, good morning to you.
Good morning.
Traditionally, back in the old days, 10 years ago, we'd say low rates, low growth, buy growth. Why is it different this time?
Yeah, so it was interesting. It's been turned on its head a bit the last several years. Big tech has been a safe haven. Fortress balance sheets, great cash flow, secular tailwinds, including and especially AI. And so that's partly propelled them to do so well in a higher rate environment. As rates have come off with the prospect of a soft landing, we are seeing some rotation to riskier assets, but assets that are a little bit more levered and that will benefit from lower rates because their balance sheets will be in better shape.
Does this remind you of the end of July when we were punishing big tech and basically buying trash? Or is it healthier? Healthy is this word we hear a lot of. What is it this time?
I think importantly, the valuation discrepancy just got too wide. And we were seeing a lot more value in smaller companies, outside of technology. And so, you know, you've seen, obviously, a lot of that correction take place already. Now, I would add an asterisk, because there's always an asterisk, which is that as we head into the election and volatility increases, you could see a move back to big tech in the short term as safe haven trades.
So the sleepy week that everyone's been looking for August, how much signal and how much noise are we actually getting? Peter Scheer was on yesterday and he was talking about the incredible volatility of the lack of liquidity of this moment and how the market's getting jerked around by some of these options trading and some of the other sort of dynamics in markets. Are you doing anything during this week? Is this a good time to take advantage?
I think it is a lot of noise. Look, you look at the charts since the beginning of July, and not much has changed. A lot has changed in the market, but not much has changed really in the economy and ultimately in the market. We're back to almost where we started. So, you know, I think it's just there are a lot of externalities. We're focused on, obviously, longer term growth. We are focused on policy differentials in the election, and that does matter, however.
So based on the longer term not changing and the short term seeing some volatility, it seems like actually a really good time to be looking for certain opportunities. If you have a certain thesis and there's certain discounts or dislocations, maybe it's a time to kind of get in. What on the margins are the strategies that you're looking to execute in certain moments?
Yeah, so listen, we are, I would say, biased towards quality and to safe havens, defensive names, names that will benefit from cuts in interest rates.
What names are those?
Those are, well, they're utilities, for example, which utilities are back. There's actually, for lots of secular reasons, increased demand. The valuations have gotten pretty reasonable, and they are historically beneficiaries of rate cuts. Some staples, some selective industrials that are, again, quite defensive, because we do expect some softness in the economy. We saw that in the second quarter earnings that we've just come through. We don't think it's a recession, but the economy is clearly slowing down.
You identified the defensive type names that benefit from low rates, utilities, staples. Then there are these relief type trades. I use the word trash. We can be a little bit more diplomatic. What's been happening with regional banks? The rally we've seen in the smaller financial names. Can you get behind some of that?
It's a little harder. So obviously, we saw a big short squeeze last week in some of the smaller banks in particular. And, you know, that's driven by, well, technical dynamics, but also the prospect of increased demand for things like mortgages and loans and perhaps some improvement in the balance sheet assets that they have. I think there's still a lot of trash out there, so I think you've got to be very selective when you're looking at those companies.
I know you won't give us a list of names that ultimately you think are trash. Can you describe them for our audience? Can you go through the kind of companies that you really don't want to own? In a moment where a lot of people are chasing this market, I can share this quote with you from Goldman yesterday. FOMO will increase. You get that sense that when this market starts to run, Chairman Powell says the things he's saying, people will come off the sidelines and they start chasing trash. What are you suggesting people steer clear of?
Yeah, I mean, bad balance sheets in particular, over-levered companies that have a lot of assets that are troubled, whether it's we're talking about banks, we're talking about commercial real estate, et cetera. Companies without pricing power. I don't think inflation is gone, and you still have to be wary of that.
Okay, I'm sorry. Before we continue, before we call things trash, we were talking about trash and zombies and all sorts of pejoratives for a long time, and then they were supposed to be washed out in this period of high rates. Are you saying that they're just all lurking out there? Tons of trash?
Lots of zombies.
Okay.
However, I would say there is cash in trash. We love the trash companies. In fact, they're amongst the largest holdings that we have, Republic Services and Waste Connections in particular. Those are great examples of terrific companies. I had to get that in there.
That was fantastic. That was good. That was class.
Of recurring revenue, pricing power companies.
Before we let you go, we have to talk about, of course, media, because that is the space that you guys focus on. And I really have one question about this Paramount deal development. I mean, it's been going on for quite a while. Now we know that Edgar Bronfman has been dropping out because essentially the process was too involved and complicated. Is it over? Do we have to stop talking about this at this point?
We need something to talk about. The media beat reporters need to have something. I mean, listen, it's not over. It appears that Skydance has one. I don't think we've heard the last of Edgar Bronfman and his group. There's got to be consolidation in the group. Too many direct-to-consumer services, too many linear networks, too much debt. That means consolidation. We see what happens with Warner Brothers Discovery and some of the other smaller names out there.
Chris, what are these media organizations struggling with when it comes to legacy TV assets? I'm fascinated by this. The month of July, let's take the month of July. Fantastic example of how engaged people in this country still are with the news cycle, particularly the politics. Absolutely dominated everything. I can't think of a time like that since the pandemic when people were so engaged with the news flow. And yet, for some reason, leaders at these companies are struggling to get eyeballs on their content. What is going on?
Yeah, well, listen, I mean, news and sports that tend to be, obviously, they're timely. They have to be consumed in real time. They're quite valuable, particularly sports. But yes, listen, the linear networks, people don't want to pay the tax. They don't want to pay the sports tax. They think there are other more efficient ways to consume content. Turns out if you actually do the math, the old pay TV bundle that we trashed for years and years is actually a pretty efficient way to consume content. It's dying slowly. It probably needs to get rolled up. They don't belong as public entities.
Is there a company you do like right now in that world?
We do actually. No, I do think Warner Brothers Discovery, for all its troubles, for all the negative headlines that its CEO has gotten, they're great assets that are very cheap, and I think the prospects there are better than the market is giving them credit for.
Chris, it's good to see you. To talk trash in more ways than one. Chris Morangi, Oakvalley Funds, thank you, sir. Equity futures on the S&P just about unchanged here. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hakez.
Hi, John. French President Emmanuel Macron is continuing talks to appoint a new prime minister after ruling out a leftist government. His office saying that the left-wing New Popular Front candidate, Lucie Castet, would be, quote, immediately rejected by all other groups in parliament. He's now pushing for a centrist coalition, trying to end weeks of uncertainty after his decision earlier this summer to call a snap election. Since July's election, France has been governed by a so-called caretaker government that can't be toppled by the National Assembly. And in Europe, shares of BHP are trading higher. The world's biggest mining company posted profit above analyst estimates. Revenue from iron ore and copper increased despite a deteriorating Chinese demand outlook. CEO Mike Henry says he still expects China to hit its 5% growth target this year. Shares of BHP are down more than 20% so far this year. And Coco Gauff comfortably advanced to the second round of the U.S. Open with a straight sets win in the first round. The third-seeded Gauff, who won the U.S. Open last year, shaking off some early rust to advance 6-2, 6-love. But not such good news for fellow American Sloane Stephens, who was knocked out in 3 sets despite winning the opening set 6-love. That's your Bloomberg brief. John?
Yahara, thank you. I'm just going to say I was there.
Yeah.
And it was disappointing that game went so long.
Oh, yeah? Why was that, John?
I was waiting for Novak.
I'm sure you were not alone. I'm sure
I'm supporting Sloane. She's 6-love up in the first set. I'm thinking, this is going to go quickly. 40 minutes, Novak comes out and watch a couple of sets and get to bed. 7-5, 7-5, the second and third set. Novak comes on shortly before 10 p.m. Eastern time. I haven't slept.
I was about to say, you've been warned, everyone. Really, how many hours did you sleep last night?
3 hours.
Was it worth it?
Absolutely. To see one of the greatest tennis players ever? Absolutely. For this morning, I've got no idea. That word trash, I think that everything's going to be trash for the next 3 hours. Up next on the program, mic's on or mic's off.
We agreed to the same rules. I don't know. It doesn't matter to me. I'd rather have it probably on, but the agreement was that it would be the same as it was last time. In that case, it was muted.
That conversation up next, live from New York City this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Stocks negative yesterday, just turning negative again this morning. We're down by 0.05%. No real drama here. In the bond market, yields a little bit higher, up by 2 basis points, 383.68. Under surveillance this morning, mic's on or mic's off.
We agreed to the same rules. I don't know. It doesn't matter to me. I'd rather have it probably on, but the agreement was that it would be the same as it was last time. In that case, it was muted. I didn't like it the last time, but it worked out fine.
So here's the latest. The Trump and Harris campaign sparring over the rules for the September 10th presidential debate. Harris's team wanted the candidates' mics on throughout the debate. Trump's team demanding these same rules as an earlier debate against President Biden when mics were muted while the other candidates spoke. Ed Mills of Raymond James with this to say on the race: if Harris continues her momentum, we will increasingly need to discuss the probability of a Democratic sweep, which is not priced into the market. Ed, we'll get to that punchline in just a moment. I'd just love your views on the presidential debate, first of all. You have to remember that this was about keeping the former president quiet on the debate stage, and then what we all witnessed at the end of June was basically that became an asset for him, protected him from his worst instincts, and it's clear that the Trump campaign want the same thing again. Ed, is this just sort of like going over the finer details, or do you really think there's an obstacle to making this debate happen on September 10th?
You know, John, there's a debate out there on whether or not Donald Trump wants to show up to this debate. And when we start arguing over the details, it raises the question even more. To your point, as it relates to mics on versus mics off, it was something that the Biden campaign pushed for because they wanted to make sure that President Biden was able to get across all of his points. However, it was something that was clearly helpful for former President Trump during that debate. When you look at a lot of the takeaways from that debate on the dial test, a number of things that Donald Trump said scored really poorly with persuadable voters. And Trump arguably had a pretty bad debate. The good thing for Trump was that Biden had a disastrous debate that overshadowed that. Harris's campaign is looking to have that mic on, and all of her campaign has been about trying to trigger Trump into going off and trying to have him come across as unpresidential, something that they think would benefit to their campaign.
And what the Trump campaign would love at this point, Ed, as you know, is to get the vice president in front of a microphone and to answer some questions. So I just don't see how the former president walks away from any of this, Ed. Can he walk away from this debate?
I don't think so. Maybe this one, but it's not going to be without a debate. And John, I think what you're referring to is that since we've had Vice President Harris ascend to the top of the ticket, there hasn't been a sit-down interview for her. There hasn't been a debate. Almost everything has been scripted, and those unscripted, moments are really where voters are going to have an opportunity to get a sense as to whether or not they're going to vote for her in November. The Trump team sees a lot of momentum in the Harris campaign and want to see if they can disrupt that with those unscripted moments.
Ed, is the only way to get her to have some unscripted moments to have these debates?
I think there will be sit-down interviews. My understanding is that she's highlighted that by the end of the month that she will sit down, and we're pretty close to the end of the month. I don't think you can get into November without that sit-down interview. If I put my political hat on, she's done quite well politically since she's ascended to the top of the ticket. And if everything's going well, you kind of sit back and let it continue to go well until you're forced to have those unscripted moments. We'll have them. It's just politically to our advantage to kind of let this honeymoon period last as long as possible, Lisa.
Ed, I wanted to go to something that you wrote in your notes, and I think that it's a really important point, that currently in polls, it looks like Kamala Harris is in the decided lead, and yet if you look at market action, a lot of people say that that's not being priced in any way, shape, or form, that actually the Trump trade is still present in many pockets of the market. Why do you think that is?
So she clearly has the momentum. But Trump has kept a lot of these swing state polls pretty close. And you add in the fact that he's underpolled historically. I went back at Raymond James and looked at 2016, 2020. Nationally, he's underpolled by about 3%. In the swing states, and in some of these swing states, he's underpolled by as much as 5%. So if a swing state is tied, is he actually ahead? And it's probably increasingly likely Harris is able to capture that popular vote. But it's only about getting those 270 electoral college votes. If we start seeing polls coming out of the convention where the lead in some of those states and multiple states have her in that lead, then we start talking about, okay, is she really in control of this race? Is she continuing that momentum? And what does that mean down ballot? And then we'd be looking at some of these Senate races. And if she gets to that majority in the Senate, that unlocks reconciliation. That unlocks the ability for Democrats to do some of the big policy things that we've seen over the last couple of years. And if she were to have 50 votes in the Senate, it would be 50 actual Democrats, not 48 Democrats plus Joe Manchin and Kyrsten Sinema. So what would be done in a Harris administration could be actually quite consequential next year. Those are the things that we are debating here at Raymond James, especially when we look at the deadlines of the twin fiscal cliffs of the debt ceiling coming back and taxes at the end of the year, healthcare reform needed with some subsidies expiring on December 31st next year as well. So lots of things on the agenda here, Lisa.
It would be nice to know what those consequential policies in 2025 might actually be. And we've had people around this table point out continuously, and I think they've made the right point, that some of the market negative things that the vice president would like requires Congress, the likes of a much higher corporate tax rate. And some of the market negative things that President Trump, the former president, would like does not require Congress, things like tariffs. So, Ed, when you start to talk about blue sweep, I think we need to spend a bit of time on this. Are these market negative policies or market positive policies that we'd see in 2025?
Yeah, John, everything in life is compared to what? And so at Raymond James, we've been very clear. Let's go through each of these scenarios. Each of these scenarios have things that are positive for the market and that are negative for the market. You highlighted the tariff policies that former President Trump wants to put in place, 10% around the world, 60% on China, getting stricter on immigration. What impact does that have on the labor force? What impact do both of those have on inflation? I think from that perspective, the Fed is going to maybe pause a little bit and make sure they understand the economic impact before they continue on monetary policy. You're right to point out the higher corporate tax rate, higher taxes on high-end individuals could have market impacts in a Harris victory. I'd be wondering if there is a Democratic sweep, would we see a lot of selling as we head to the end of the year, as people would maybe try to get ahead of higher capital gains rates or higher taxation on dividends? These are all things that we know what the possible impacts would be, but we need to know the outcome of the election. So I would be surprised that we have some weakness heading into the election, only to see kind of that certainty reverse and kind of picking those winners and losers pretty immediately after the election here, John. So paying attention to kind of each of these policies is really important.
I want to sit on that for a second. We heard from Warren Buffett that actually one reason why he hasn't been deploying his cash, he's actually been selling, including some of his Apple shares, is exactly to get ahead of those capital gains taxes. We see right now that there is a likelihood that Kamala Harris, she has endorsed the tax rate going from 21% to 28% for big corporations. Just how big of a shift in markets could you see on the heels of some of those policies? Things that really have not been treated with any seriousness in markets.
Yeah, so on the capital gains rate, we've gotten a lot of questions of the proposal that Biden and Harris submitted to Congress earlier this year, which is for households above $1 million, the capital gains rate would go to ordinary income, plus a couple of additions to some of the payroll taxes that you pay. So it would get up to 44.6%. That's on a relatively small percentage of individuals, but it becomes a question of how many assets are subject to that. We saw a couple of years ago, as we were debating some of these similar policies, that when proposals came out in Congress, there was some selling ahead of that that caused some areas of volatility. Ultimately, it proved to be the wrong thing to do from a market perspective. But people are funny. They want to make sure that they get in ahead of any potential risk. And even if it proved to be wrong, I wouldn't be surprised if they try to do it again, especially since on taxes, you can't make it retroactive. So anything that gets done before January 1st, from a trading perspective, wouldn't be taxed. But anything after January 1st could have that impact. That's why I could see that little reaction after the election here going up into year end.
Just before you go, given how tight this race is, and given what you said about the former president underpolling in many circumstances, can you walk us through your favorite way to read this race? What do you look at?
I think you have to look at everything, John. I think you look at kind of sentiment, look at some of the predicted markets, look at polling, have conversations with voters. It is really a mosaic. And I think we also have to be humble about the fact that we've had a number of surprises in elections past. So as we get closer to the election, I just will caution folks, to the extent that you really think you know exactly how this is going to play out, we could be in for another surprise. So don't get too over-levered to any outcome. Understand that this is in a voter's hand, and we have 150 million people vote. Predicting that's very difficult.
Ed, thank you, sir. Ed Mills there of Raymond James on the next couple of months. I thought Buffett wanted to pay more in taxes. Isn't that the whole shtick?
Shtick or not, that was the theory behind the Apple stock. By the way, I love how you try to get clarity. And people are like, you're like, what's the sort of secret bullet?
No secret.
Everything is relative. People are funny. Kumbaya, who knows?
Something like that. More on the crude market. Up next, we'll catch up with Ellen Wald of the Atlantic Council.
many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Equities on the S&P 500 just about negative. We're down by 0.06%. The pullback yesterday, a little bit more dramatic on the Nasdaq side of things. The Nasdaq 100 down by more than 1 full percentage point. The leadership we saw though last week, particularly the end of last week, just continued into yesterday's session. Now, Lisa, people throw around this word healthy. They see better participation and they say that's healthy. But what if we're talking about companies that aren't so good, just getting chased because they've missed out on the rally so far this year, encouraged by the prospect of lower interest rates?
It's noise that's being cast as healthy at a time where people have been really hoping for this broadening out that can sustain the rally. There's a real ultimate question of whether a weakening economy is equal with this idea that we're seeing baked into markets, that some of the weaker names can perform. Is this a head fake? And I think that that's what NVIDIA's earnings are going to show, especially at a time where we don't understand whether rate cuts are good or bad for some of the big tech names.
Still trying to figure that one out. NVIDIA up tomorrow after the close. Let's turn to the bond market. Switch on the board and turn the page and get to the 2-year, the front end of the curve. The 2-year yield up by about a basis point to 395. A little bit later on this afternoon, 1 p.m. Eastern time, $69 billion of 2-year notes. Then later in the week, some 5-year notes. Then Lisa again, some 7-year notes. A lot of debt coming to market this week.
I want to see the 7-year note. I'm more interested in longer term debt right now than shorter term debt, although there is some question about whether we've priced in too many rate cuts. Longer term, at what point do people start looking at not only the deficit and all of those concerns, but also the idea that if the Fed is trying to get ahead of weakness to cut rates sooner, does that mean that they actually have less capacity to cut rates as significantly as people think longer term, just simply because they are going to keep the economy afloat and potentially even some of those inflationary pressures? And that's what we heard yesterday from the Richmond Fed president in an Odd Lots podcast. I am very curious about this. Tom Barkin was talking about this, the reinflation types of concerns that could come back.
I mentioned that word FOMO earlier on this morning. We'll catch up with Phil Camparelli of JP Morgan later on, about 8 a.m. Eastern time, so 90 minutes from now. Overweight US stocks, overweight EM, overweight Japan, overweight high yield credit, underweight core US bonds. How many people are in that boat right now where they're chasing this equity market? To be clear, Phil's been bullish for quite a while. This is a market he's been participating in. But a lot of more people want to sort of jump on that train and chase things into year end after what we heard from Chairman Powell on Friday.
Well, this goes to the point of if you have all this money in money markets, does it just go into bonds or does it go into everything as you start to move out the curve or you start to go away from, say, core money market funds to try to get yield? It's a good question. It seems like there's a tension even within the same shops. It seems like get Phil Camparelli and Bob Michael in the same room, they might have a different opinion, but I do think longer term, this really is the ultimate tension. Can you get the good kind of rate cuts that are as deep as this market is expecting?
They're big places. We welcome different views. Of course we do. Let's turn to the FX market. The dollar, DXY, 5 weeks of dollar weakness coming into this week. The longest weekly losing streak of the year so far. The euro going nowhere at 111.62. The dollar against the Japanese yen up by about 0.2%, Lisa, just short of 145.
This is actually what I'm watching more than anything. This is actually one of the biggest risks that I keep hearing about heading into September, which is dollar weakness and protracted dollar weakness, given how much people were sort of overweighted to the dollar over the past 12 months. How much does that start to reverse as people price in some of these those rate cuts, especially as you see maybe signs of strength elsewhere. But to me, that's what you hear these stories about money that's being, sold out of China and the yuan appreciation of 10% and what's going on with the Bank of Japan. Either way, it's just how much is this market coiled with that being a potentially disruptive trade?
Which economy would you like to own? The one where they're cutting interest rates and the economy looks really bad, or the one where we're cutting interest rates and, for now at least, unemployment's still around 4%, inflation's coming back towards target, and things look okay for now?
Are you throwing shots at Europe?
Maybe a few shots at Europe.
Look,
to be even more specific, maybe a few shots at Germany.
I know, okay. And a lot of people would agree with you, but it's all relative, as we just heard from Ed Mills, and people are funny. Also, we just heard from Ed Mills. And there is this question of whether we've already priced that weakness in, and whether we haven't sufficiently priced in the weakness that it seems like Fed officials may be seeing in the U.S. economy. And I think that that's sort of the existential question. I think Kit Jukes is going to come on and tell you, stop worrying so much about dollar weakness, and we'll have that conversation coming up.
The euro, 111.63. There's your tease for the FX market. Under surveillance this morning, President Biden's top security advisor, Jake Sullivan, landing in China for a 3-day visit. Sullivan expected to raise concerns over China's continued backing of Russia in its war against Ukraine, while Beijing is expected to raise the issue of U.S. tariffs as well. We mentioned Germany, just a derivative of this story right here.
Yeah, basically how much these tensions are ratcheting up. And we saw yesterday from Canada, they actually piggybacked what the U.S. was doing. I do wonder, and there was an interesting article in the Financial Times about how it's sort of which side, pick your poison, a Trump campaign or a Harris campaign for the Chinese government, which is worse, and how are those tariffs going to evolve? I think it's a legitimate question. I don't know the answer, but this is a bipartisan kind of effort. And I'm curious why this is coming now. What is Jake Sullivan going to be talking about with the Chinese authorities at a time where he may not be even relevant in, say, 6 months' time?
Yeah, how much leverage do they have, given what's about to take place in this country in early November? Let's talk about Apple, set to announce the new iPhone 16 on September 9th. Investors looking for details around Apple Intelligence, the company's suite of AI features that will be available on all its new models. I say September 9th because we reported September 10th. Internally, based on our reporting, that was the date. It's been brought forward just a little bit. Unclear whether that was because it clashes with the debate, the presidential debate on September 10th. No real explanation.
So I have nothing to say about this except for that, which is essentially how much are they trying to get ahead of that so they don't have to compete with September 10th, where all eyes are going to be on the Harris-Trump campaign and that debate. I don't really know the answer, but that was the first thing I thought when I read this. Smart. They want as much buzz as they possibly can. Rather than do it September 11th, they're going to do it on September 9th to get ahead of that, given that there isn't that much oxygen in the room left.
I've got lots of things to say about Luca Maestri. We could do that a little bit later. The CFO stepping down to a smaller role, being replaced. What a run. 10 years.
Yeah, but he's still going to be there, right? I mean, this is sort of a shepherding in of the new guard while he's still going to be there. He's some 60 years old. I imagine he probably wants to spend more time actually enjoying the amount of money that he's made. And I'm assuming that that's part of the reason why, as they try to pave the path to a new guard, they've done this in a couple of different roles. But yeah, it's sort of interesting to see how they try to change the page in a more controlled way than some of the exits we've seen in other
We'll build on that story in the next hour or so. Let's turn to crude. Lisa was on top of this story yesterday. Wall Street starting to sour on crude. Both Morgan Stanley and Goldman lowering their price forecast. This coming as oil steadies following a 3-day rally as the threat of a halt in Libyan supply is offset by a shaky demand outlook. Adam Wald of the Atlantic Council writing the following. A drop of Libya's 1 million barrels from the market was not something foreseen by anyone and could introduce a period of tighter supply before OPEC Plus starts increasing production as they intend in October. So, Adam, can we start, and welcome to the program, can we begin in Libya? Can you walk us through what's happening, your read of things, and how temporary this might be?
Yeah, this is a really interesting situation that is developing. The government in Libya seems to just have ordered a complete stoppage of oil production and oil exports for reasons that we're not entirely sure of right now. I think that more will probably emerge as the situation develops. But it seems like they're not entirely familiar with how the process works. You can't just turn off the taps and suddenly everything stops. And so the oil companies that are producing Libya's oil, they're all subsidiaries of the national Libya's national oil company, are saying, we're going to start slowing things down, obviously, but we can't just turn everything off on Monday because you say so. And so we're definitely expecting to see less Libyan oil production as the week goes on. But the question is, how much is going to come off the market? Is this a long-term thing? Is this a short-term thing? What's going to be resolved? Because when you're talking about, over 1 million barrels of oil a day, this isn't just a nothing to the market.
Brent crude has risen 7% over the previous 3 trading sessions, which is the sharpest rise going back to April of 2023. And this comes at a time where there are real questions about the OPEC Plus reaction function, how much they want to keep prices where they are to pressure, say, the shale patch to get a competitive advantage in the face of a lot of production in the United States. How much is the swing factor here? Is this essentially this disruption or potential disruption in Libyan oil production and output only going to push OPEC Plus to increase production of its own?
Yeah, I think that the signs so far have been headed towards OPEC maybe pushing off its planned production increases. We saw OPEC revise its demand forecast down recently, which their forecasts were quite a bit higher than everyone else's. They generally tend to be, but they were really kind of out of whack, it seemed. And so that downward revision was expected and anticipated because it had to happen in order for the group to be able to maybe reconsider putting through their planned increases. But if Libyan oil is going to be off the market, for the foreseeable future, if this continues, through August, through September, and once we hit October, there's going to be a lot of pressure on OPEC to actually do the opposite, not to rein back their planned increases, but maybe even to increase more to compensate for the lack of Libyan oil on the market. So it's really a situation that I'm sure OPEC ministers are monitoring very carefully because they're going to want to react and not jostle things too much. I think that they definitely like prices pushing the $80 mark, but at the same time, they don't want to see, prices in October soaring, too much, I think, over 85 or 90, because that's also not so good for them.
Ellen, when you take a step back, there's a real question of what are we missing? No one was really putting Libya on their bingo card, not that many people, when they were talking about what could potentially cause oil prices to surge. They were talking about Israel, Hezbollah, Iran. They were talking about what's going on with Russia and Ukraine. How sort of fragile is the situation with production right now, given the hot spots that are emerging in multiple places?
So it's interesting because, some days you look at the economic data and it seems like, gosh, there's just way too much supply out there for where we think demand could possibly be headed. If the economy starts to really slow, then, the supply will seem too high. But then at the same time, there are other signals pointing to robust economic growth, which means that we need more supply. And so that says that a problem in Libya could really impact the whole market. And so it's these kinds of things that you don't anticipate, a sudden shutdown from Libya or a sudden weather event that takes out production in the Gulf of Mexico for a little while, or potentially something in a place we have no idea. There could be a problem in Guyana or in Brazil that we have no idea that could pop up. And that's one of the reasons why OPEC likes to have this ability to suddenly react, to suddenly increase its production, which it can do. It's holding on to a lot of spare capacity right now that it could put on the market if it's ever needed, but at the same time, it doesn't want to flood the market and cause prices to go down just at a time that maybe the economic situation is also going down.
Let's drill into that a little bit more. I mentioned the revision from Goldman. I'll share some of that note with you, Ellen. We'd love your reaction to it. We reduced our range for Brent prices by $5 a barrel to 70 to 85. The 25 average Brent forecast is now 77 versus 82 previously. They say that reflects upside surprises to OECD inventories. And here's the quote that jumped out for me. We still assume that OPEC will raise production in Q4 as the market is potentially shifting from an equilibrium where OPEC supports spot balances and reduces volatility to a more long-run equilibrium, which they say will be focused on strategically disciplining non-OPEC supply and supporting cohesion. Ellen, forgive me for asking you to translate that last line, but what do you think that means in practice?
Yeah, I think that's some interesting language. Disciplining non-OPEC supply is a way of saying we want to keep you in line by keeping prices not too high so that you can't expand your production. In other words, we're going to treat non-OPEC supply as though it is an OPEC plus supply, and we're just going to use a different method of pressure. I think that's pretty intense. I do think, though, that they have to understand that the non-OPEC supply right now is not the same market, it's not the same industry as it was in 2015, 2016, 2017. This is a whole different game in the Permian now. There has been an absolute ton of consolidation and big consolidation. We're talking about many, many fewer producers. This is not the kind of market where it's produce or die. It's produce at all costs. It used to be produce and produce even if you were not even making even just because you had to keep up with payroll. That's not the case here. We've got increased well productivity. We've got much larger corporations running the show here. And I think they're going to find it much more difficult to discipline non-OPEC production if they're really talking about the Permian than they think.
Do you think they are talking about the Permian, though? Or do you think they're talking about places like Guyana?
Well, I think that the problem with places like Guyana is that, those are much longer term, larger projects that have been in the works for a long time, and they can't just turn that on and off. These are things that have been well forecast, well played out. They know exactly how much is coming online at every given time, whereas in the Permian, it's still more of the short term wells. The wells are still more short term, and so there is a lot more flexibility there to reduce production than in a place like Guyana, where the projects have been, they're very long-term, big projects. They can't just be turned off.
Got it. Ellen, thank you. As always, one of the best. Ellen Wald there at the Atlantic Council. The latest on crude. Crude this morning down by about 0.6%. Brent, just a break of 81. Let's give an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers.
Hi, John. Meta CEO Mark Zuckerberg alleged that the Biden administration pressured Facebook to censor COVID-19 content in 2021 during the pandemic. Zuckerberg made the admission in a letter to the House Judiciary Committee and said the content included humor and satire. Looking back, Zuckerberg said, quote, "I believe the government pressure was wrong, and I regret that we were not more outspoken about it." Meanwhile, shares of Paramount are trading lower, more than 4% in the pre-market after Edgar Bronfman Jr. announced he was dropping out of the bidding war for the company. Bronfman submitted a $6 billion proposal for the entertainment company last week, challenging an earlier offer from Skydance Media. Sources say Skydance accused Paramount of breaching the terms of their merger agreement by continuing to engage with another suitor. And the first ever private spacewalk will have to wait. SpaceX has scrubbed this morning's scheduled launch of Polaris Dawn due to a ground-side helium leak. One of the 4 civilian astronauts is billionaire Jared Isaacman, who's flown with SpaceX before and provided the funds for this mission. Isaacman and SpaceX engineer Sarah Gillis are planning to step outside the spacecraft on the 3rd day of the flight and both perform a spacewalk. The next launch window for Polaris Dawn is no earlier than tomorrow. That's your Bloomberg Brief. John?
Yahara, thank you. Can we keep those pictures up? Getting a star review in real time from Bramo. You love this, don't you?
Well, I spent a little bit too much time focusing on those custom-made spacesuits that are much easier for them to get on in zero gravity. And they can plug in to oxygen. They look like they're more malleable. They like the basic essentials.
I'm with you.
I think they look pretty awesome.
It looks very cool.
Yeah, that's
it looks very cool. Well, thanks for that. Up next on the program, avoiding an injury.
We don't want to get ourselves into a situation where we're keeping policy highly restrictive into a slowing economy. That's a recipe, if you will, for over-tightening and injuring the labor market and growth.
That's next. You're watching Bloomberg TV.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change, In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Equity futures here negative by almost 0.1%. Welcome to the program. If you are just joining us in the bond market, yields creeping a little bit higher at 3 basis points. The 10-year 384.63. Under surveillance this morning, avoiding an injury.
I do see that adjusting policy is appropriate. We don't want to get ourselves into a situation where we're keeping policy highly restrictive into a slowing economy. And remember, every time inflation comes down, the policy gets more restrictive. And I think that's a recipe, if you will, for over-tightening and injuring the labor market and growth.
So here's the latest. Traders circling weekly jobless claims and next week's August jobs report as key data points ahead of the Fed's next meeting, as officials warn of potential harm to the labour market. Kit Chiefs of SocGen writing the following: while the labour market is clearly loosening, there's still huge uncertainty about how much it will slow. But for the FX market, after the dollar climbs so high, the mere fact of the slowdown will continue to see long dollar positions reduced. Kit joins us now for more. Kit, so we've got the economy and then we've got your call on the central bank and foreign exchange. Can we just start with the economy first and ultimately the call on the central bank? Market participants were very excited at the start of the year about the prospect of a lot of rate cuts. They took them all back and now we've priced them all in again. What's different now compared to where we were at the start of the year?
Good question. I think the first piece is that even the Fed is recognizing pretty clearly that the labor market is changing. Jobs growth has slowed. We've revised away a few jobs as well for the last couple of weeks, but it is slowing down. There's signs of weakness in the housing market still. So what the Fed has done is beginning to have an impact. But labor market is the center of it. That's why it got more mentions than anything else at Jackson Hole. And we've seen one weak labor market report, one downward revision in the benchmark revisions, and we're waiting for more to provide any kind of confirmation. I guess I would say, though, that the chances that this is a slowdown are pretty strong now. What kind of slowdown? Much less certain. But there's enough in the labor market here to say this is now slowing.
It's okay with that in mind. Are we too dovishly priced or too conservatively priced in the rates market at the moment?
Well, if you push me against the wall, I say we're pricing for a faster pace of rate cuts than is likely unless things go pretty badly wrong. But the destination, which is looking at an eventual fall into 3% or somewhere near 3% in rates, that's not an excessive fall. The last time the trough in rates was 3% was in 1992 when inflation expectations were an awful lot higher than they are now. Real rates were less restrictive, and the economic recovery that we had when we got to that trough surprised everybody, and we called it the Great Moderation. So the destination of 3%-ish, I think is fine. The idea that we get as many rate cuts between now and the beginning of next year as are priced in, that the data need to be pretty awful.
Kit, I was wondering whether this was going to be sort of the dramatic salvos that could be heard across Wall Street during the fall, given the fact that so many people for most of this year had been so overweight the dollar. How offsides will this market be when it starts to adapt to the idea of the rate cuts that the market is pricing in, if we should get the kind of cuts that currently are being represented in Fed funds futures? How much dollar weakness could we end up seeing?
Well, a fair bit. I mean, that's my concern. There's a piece about the Chinese yuan that was the most read story on your terminal overnight, citing Stephen Jen, who talked about an avalanche of money. But I've been struck for years that the two big dollar rallies, the really big one in the 80s that ended in 85, and then the big one in the 90s that ended in 2001, both of them were completely reversed. The first without any kind of recession, the second with a very mild recession. And there is this sense that we've seen, not just carry trades, but foreign investors buying U.S. equities, foreign investors buying U.S. bonds, everybody buying American everything for years now. And that if people start taking those trades off, bringing that money home, whatever it is they're doing with it, because they're a bit spooked, that you can have an outsized correction on the other side over the course of the next few years. And I, for one, definitely never saw either how much the dollar was going to go up into 85 or how much it would fall, and was continually perplexed by how strong it got, and then how much it fell in between 95 and 2004. So I'll be surprised again if the dollar goes all the way back, but I'm beginning to understand how it happens. And it's this, if you like, it's this avalanche, to use the term from the Bloomberg story, but of just money going home because it's had a great time being in America, but the holidays are over.
Kit, the holidays are over, but are they really beginning at other places? I hear John Farrow's voice in my head. Where do you want to go? Germany? Where do you want to go? China? I mean, there's this question. I mean, how much confidence is there in a lot of these companies, a lot of these investors, to go home from the holidays?
And that's the really big challenge. In a sense, if I look at Japan and say, well, if dollar yen, purchasing power parity for dollar yen is now in the mid-90s. How far could that go on no money doing anything? That's a big current account surplus economy. If it doesn't want to ship money to the States, the yen will appreciate an enormous amount. I can't imagine euro-dollar going miles. I think, let's put it this way, that I am almost certain in my mind that we're going to see another cyclical lower high for the euro after a series of them since 2008. So we did 160, we did 140, we did 127, then we did 123. I don't think we're getting close to 123 in this cycle. But I do look at history and say, once a stone starts gathering momentum, it goes down. Or put it another way, what are the conditions for an avalanche? A lot of snow at the top of a mountain and a catalyst. Where does the snow go? Down. It's not asking how attractive it is at the bottom of the valley. It's just going. And there's a bit of that in this.
Okay, before you go, I've only got a few seconds left. I've got to know, did you call Stephen and ask him about that call?
No, I haven't. I've only got. This is my first day into work. I'm as close to his office as I could usefully be in your studios in London, but I have not spoken to Stephen yet.
Okay, let me know what you tell him. Kit Jukes of SocGen, with a really interesting call that we wrote up from Stephen Jen. The two of them are friends, if anyone is wondering why I asked that question. Chinese companies may be enticed to sell a $1 trillion pile of dollar-denominated assets as the US cuts interest rates, a move which could strengthen the yuan by up to 10%, according to Stephen Jen.
Yeah, and Stephen Jen was the one who coined the dollar smile.
Yeah.
So he's a very respected person in the FX market. But this is one of the fears. What are we missing in terms of how offsides this market is with respect to dollar strength into this type of cutting cycle?
Massive call, just massive call. Coming up on this program, the second hour of Bloomberg Surveillance with Sebastian Page of T. Rowe Price, Bloomberg's Mike Shepard, Matt Stuckey of Northwestern Mutual, and Oliver Chen of TD Cowen from New York. This is Bloomberg.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
to succeed in Wall Street,
Yeah.
what skills do you need? You need to be somebody who claws people on the back, people that you have to be tough,
Yeah.
you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know